Hit it.
It's Friday, September 9th, 2022, episode 194. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, Rob Arnott from Research Affiliates joins us. We have a fascinating discussion about value versus growth stocks, the yield curve, and whether it's predicting or causing recessions, and why Rob thinks inflation will stay persistently high. Then our favorite technician, Patrick Ceresna, empties his mouth of his charting crayons to tell us what he sees in store for the markets.
We then end with the segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer am I drinking this week?
So this week, Patrick is drinking Cerdos Voladores IPA. I believe this is a Barcelona
for people
beer.
that don't, yeah, it's a Spanish beer, yeah, and because I was in Spain just last week and I grabbed this, but it is Flying Pigs for those that don't speak Spanish.
Flying pigs. When pigs finally fly.
Exactly. Anyway, but Lena, do you have a description for it?
Yeah, so the three little pigs are back, turned into beer. Welcome to the world of the Flying Pigs, our friendliest and most hooligan craft beer. A beer to enjoy the special moments in life. A good meal, a good football game on TV, a night out with friends. Your most powerful and cheeky craft beer for your happiest moments, with a lot of hops that give it that strong, bitter taste that will make you addicted. Join the Flying Pigs and you will remember that life is meant to be enjoyed. Be pork, my friend. I'm assuming they meant be pigs.
Description.
But anyways.
I'll tell you what, I just had a sip and I love it. It's actually, I haven't come on the show and loved a beer in a while. This is a pretty good taste. Flying Pigs do exist.
When pigs finally fly has happened.
Anyway,
nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much Huddle may include chlamydia, gonorrhea, type 2 diabetes. Thanks to Sam for those.
Yeah. So listen, before we get to our interview, I just wanted to do a quick plug for the Montreal Exchange. We have good friends over there. They're launching, Kev, a competition to become Canada's top options trader. There's an 8-week competition on their simulator. It's free to join, and there's all sorts of cash prizes and stuff like that. And you can go to the Montreal Exchange website at m-x.ca/options contest for those that want to participate in this. It's a fun way of just testing whether you can win some money making some strategic options trades. Anyway,
am I allowed to short vol naked there?
I think so. You can give it a shot, buddy.
Okay.
All right, let's get to our interviews.
It's our great pleasure to welcome to the show Rob Arnott. Rob is the founding chairman of Research Affiliates, a firm that manages $150 billion in institutional assets. Rob, thanks for joining us.
It's a pleasure.
I've been looking forward to this for a long time, Rob. I got so many questions, and I've just got my list of different research things, and you're probably going to be sick of me by the end of this. But before we get to those, why don't you tell us a little bit about yourself? Because you have a long, career with lots of papers written, lots of accolades behind your name, and I don't know how you got into the business. I'd love to hear your story.
Well, thank you very much for that. I got into the business by design. I wanted to be in the investment management business. When I was in high school, I was avidly interested in the markets. I was also avidly interested in astrophysics, and I was trying to decide which to go into. And as I headed off to college, I realized that while I'm very good at math, there are people out there who are better than me at math. And in astrophysics is math. So if I wanted to be a world-class astrophysicist, that wasn't going to happen. Meanwhile, in investing, scientific method wasn't used back then. It just wasn't. The term quant hadn't even been invented. And scientific method is a powerful tool. So I was a quant before the word quant was invented. I started publishing papers on my research. I started investigating how markets work using scientific method. and began to build a reputation. I was tapped to be editor-in-chief of the Financial Analyst Journal in 2002, a position I held for 4 years. And that was my part-time job while I was busy running a money management firm.
Right. So before we go into this, because I find this fascinating, and that you had this, let's just say, this vision to use the scientific method in trading / investing. And what year was this, and where did that inspiration come from?
That would have been 1977 is when I graduated from college, but I'd already set my sights on investing as a career. About 5 years before that.
Okay, so you were always interested in the markets. Can I ask what university you went to?
University of California, Santa Barbara.
Oh, you did. Oh, you enjoyed yourself. And when you went there, you're taking. Is it economics, finance? What are you taking?
Well, I did 3 majors: applied mathematics, computer science, and economics. I was probably their last ever triple major because they changed the rules in my last term to limit you to 200 units. And before that, you couldn't apply for a new term if you'd already exceeded 200. Now they said you couldn't do more than 200 units, and you can't do 3 majors unless you're willing to do about 220 units.
Right. So. Okay. So you're there. You're doing that, and at this point, you got your sights set on becoming a money manager / something in the investment industry.
Yeah, absolutely. I was working my way through college. I was self-supporting from about age 16 or 17, and I was working my way through college as a computer programmer. So I went into finance as a computer programmer, and when you're applying for work out of college, it's a numbers game. You apply for a lot of jobs. I sent out about 500 letters and resumes, and this was back before you had Xerox machines and before you could print a letter lightly edited from your computer. It was a matter of just typing the letters. And so 500 letters led to about 10 interviews, which led to 4 job offers. And I took the one that had the lowest pay.
Okay. Why was that, and where was it?
It was with the Boston company. They wanted me to come in as a programmer. I wanted to do research. And I said, I'd like to carve out a day a week to use your data and your systems to do research. And they said, well, that's fine. We'll pay you for 4 days a week, and you can use the 1 day a week and use our systems and databases however you like. And
wow.
So I was basically doing the research on my own time, but obviously that set the stage for my career a lot more than the computer programming did.
That was an amazing foresight. Did people around you think you were nuts?
No, because the pay was pretty good already. I mean, computer science was well paid in the 70s, just like it's well paid today. And
was, I guess, but though in the 70s, what was big difference was getting access to computers was a lot more difficult.
Yeah.
And you must have been one of the few doing that sort of research.
There would have been dozens. Now there's thousands.
Right. Okay, so you're a Boston company, you're there. Tell me how your career evolves from that point on.
Well, I was invited to become chief investment officer at TSA Capital Management in California at the ripe old age of 29. That was described in the LA Times as a sleepy old trust company.
Okay. But it is in California.
It is in California. And I wanted to move back to California at the time. And an opportunity to run a business, even one that was described as sleepy old, maybe I could wake it up a bit. and I ran headlong into California employment law, where I was told I could shake things up, and quickly found that I couldn't.
Oh, you couldn't get them awake.
No. If they wanted to sleep and they'd been on the job sleeping for 30 years, they could continue sleeping. And so I basically built a new team, small team, built some products, and after 3 years, we had about $3 billion under management, which back then was pretty good.
Oh, it's monstrous.
And I was then recruited to Salomon Brothers to be a global equity strategist, which was interesting because when I got there, I realized I could be an equity strategist as long as I didn't disagree with Bob Solomon on the equity side or Henry Kaufman on the bond side.
So what year was that Dr. Doom was still working there?
That was 87.
Oh, good timing.
Yeah. And I arrived a few months before the crash. I was deeply worried about the market getting overextended. My models were saying, get the hell out. I pulled the head of equities aside and said, here's what I want to say. And he said, you can say that, but I don't think you'll like the consequences. So I negotiated the right to send out a quantitative newsletter, which was called Signal Research, so that it wouldn't attract a large audience.
That's right, and they could say, "Oh, that's the weird quant guy saying that." Just ignore him. Right.
And so I wrote the first piece, which went to press. Went to the mailroom on October 19, the day of the crash.
Oh.
And so we pulled it from the mailroom because it was suddenly irrelevant. Anyway, handwriting was on the wall. So I moved on to First Quadrant, money management firm based in New Jersey, and negotiated the right to move to California and work out of California.
Oh, you were the first stay-at-home. Before we go on, I have to ask: in your brief time at Salomon Brothers, did you cross paths with Michael Lewis?
I was there at exactly the same time as him.
Right,
we were
that's
in
why.
Totally different areas. So I was.
Oh, okay, because you were in the equities, and he was in London and stuff. So you go to First Quadrant, and I'll just for I actually remember I am a former equity derivatives trader at from RBC in Canada, and I remember getting orders from First Quadrant. Yeah, so I do remember that they were these weird VWAP orders. This was in the early 90s, and not a lot of people were doing VWAPs, and you guys were sending orders and insisting on the VWAP, which I thought was kind of interesting. Mm-hmm. Why don't you tell us a little bit about that firm and what you did there and how that worked?
Well, we built quantitative methods for global asset allocation. We also developed models for quantitative equity management, which was a predecessor of modern factor investing. It was multiple stock selection models layered together for a composite score for attractiveness, which is much like what happens in factor investing today. The asset allocation work, we were not the first, but the largest and most aggressive in the use of futures markets to handle implementation. So if somebody had a $1 billion portfolio and they wanted to be able to swing it 200 million into or out of stocks, they could do that by buying or selling 200 million in stocks, or they could do that by buying or selling 200 million in stock futures, which would require them only to set aside about 10 million in collateral. So that's means that the futures were overlaid on the assets. We actually called it a futures overlay, and charged modest fees on the effective size of the strategy, the 200 million, which
tacitly would be fairly large fees on the collateral.
Right. Okay.
That's because it didn't require people to move all of their assets to us. We wound up being able to build a business of about, it was about 32, 33 billion by the time the tech bubble burst.
Wow.
And subsequently shrunk in half, not because our performance was bad, it was very, very good, but because clients were forced to de-risk. And so that was an exciting time. We had a parent company, Affiliated Managers Group. I did not enjoy working with them at all. Okay. And so I ultimately decided, if I'm ever going to start my own business, I ought to do it now. I was already late 40s by then. I actually had dinner with Jack Bogle.
Right.
He started Vanguard Group when he was 48. I started Research Affiliates when I was 48.
Wow.
And so had dinner with Jack and picked his brain on the nuances of starting a business. Had a wonderful conversation with him. Pitched him on a couple of our ideas, which he dismissed out of hand.
Way too complicated. Why are you confusing things?
Yeah. He said, just buy the market. And
I said, just can you get our fees down? That's all that matters.
Yeah. I said, you got that base covered. I have to do something different.
Right. All right. Anyway, so 48, you come out of the dot-com bubbles crashed and you go off to start Research Affiliates. Is that correct?
Actually, in the depths of the bear market and the depths of the recession, the 2001 recession, 2001 to 2 recession. I did it because I had developed confidence. This was going to be the third firm I started, and luck plays a role. It plays a very big role. But I also realized that a lot of people just don't think outside the box. And so I felt I've got enough personal resources to do this for 2 or 3 years. And if I'm not at break even by then, well, then I have to go get another job. But
luckily you didn't. And now you're managing billions and billions of dollars. And so from there, so that's 2001 or 2002 or somewhere around there.
March of 2002 is when we launched. And our first client was PIMCO. PIMCO invited me in late 2001 to present to their full team. It was described as a secular forum presentation, but it wasn't actually at the secular forum. It was with their broad audience. And I spoke about my views on markets, which happened to match very closely with their views on markets, but approached it from a totally different perspective. And so they realized, this is complementary not because it agrees with us, but because it approaches things from a different direction. And Brent Harris, who was chairman of the funds group at the time, was getting ready to launch the All Asset Fund. So a lot of people think All Asset was my idea. No, it was Brent Harris's idea. And he wanted to have the world's first global asset allocation strategy that focused on real returns, that anchored on real return-oriented assets like TIPS, and that used the whole spectrum of asset classes around the world to gain access to diversifying markets. So it was going to be arguably the first asset allocation fund that didn't anchor on mainstream stocks and bonds. And of course, today, almost all of them still anchor on 60-40. So if you are invested in stocks and invested in bonds, and you then buy an asset allocation fund, you're just doubling down on what you already own. Well, All Asset sought to approach things from a totally different perspective. And we had a we compared calendars and discovered the next time we were going to be in the same town was about 6 weeks later in Tokyo. So we arranged to have breakfast. And Brent's a very decisive sort of guy. He said, I'd like to do this with you. And I said, great. Do you want to do it with my new business that I've just started or with First Quadrant? And he said, which of them will pay you more of the revenues that we send you?
That's nice.
The new company. And he said, well, I want to do it with the new company. And I said, I have to clear it with my partners. Then the topic of fees came up. And I said, well, you don't want to tell me what you're thinking you want to pay me. I don't want to tell you what I'm thinking I should receive, because that tips our hand. So why don't we both write down what we think is a fair number and exchange scraps of paper? We both written the same number, 20 basis points.
That is a terrific story.
So I then went back to my partners at First Quadrant and I said, I've been invited in my new company to run an asset allocation strategy. This was the dominant business of First Quadrant. This was right in their sweet spot. I said, it won't be a futures overlay. It'll actually be a fund of funds. And they said, that sounds fine. I said, we have to build models for emerging market stocks and bonds, for tips and for commodities. And we don't have any of those models. So I'd like to do this outside of the company. And they said, well, what are you going to charge? And I said, 20 basis points. And they said, that sounds a little skinny. They said, how big will it be? And I said, well, they're seeding it with 3 million. So the starting revenues will be $6,000 a year.
And they let you go your own way.
They said, that is not interesting. And I said, okay, good. So that strategy is currently about 17 billion. And I'm no longer getting 20 basis points, but it's
as everyone does the math, trying to figure out how much 20 basis points is on.
But it was a wonderful adventure, and PIMCO was a fantastic partner in helping us get started. Then we came up with fundamental index, the notion of anchoring an index to not to the market cap or the market value of the companies, but to how big their business was, their economic footprint. So if you think of conventional indexing as seeking to replicate the look and composition of the stock market, fundamental index seeks to replicate the look and composition of the macroeconomy, the publicly traded macroeconomy. And it has an inherent value tilt because value stocks, the out of favor, unloved stocks, fundamental index will say, market hates this company. It's got headwinds. So fundamental index will say, thanks for the deep discount. I've got to top you up to your economic footprint, which is a much bigger allocation. Frothy growth stocks trading at high multiples, fundamental index will say, yeah, but your business isn't very big. Thanks for those great gains. I'm going to trim you back down to your economic footprint. And so you have this natural rebalancing inherent in the strategy that not only de-emphasizes growth and emphasizes value, but more subtly and more importantly, it'll contra-trade against the market's constantly changing expectations. So as a growth stock falls out of favor, fundamental index will say, oh, the stock's gone down. It's now smaller in the portfolio than the size of its business. I better top it back up. So whatever is most unloved in the market, we're going to be buying it. Whatever is most loved, we're going to be selling it. And that inherent contrarian element is the essential component of the success of fundamental index.
So can I jump in here and ask you some questions about that fundamental index? Because I think it's a fascinating topic that not enough people think about. And one, just the whole idea of cap weighted. And I get it if you're a big, huge pension fund and you have a liquidity issue that you might need to use cap weighted because you're trying to put so much money to work. You can't go buy big pieces of small companies. But I've looked at the papers, and one of the things when people ask me, at me as a small investor, how I can outperform the market, I say one of the easiest arbitrages out there is equal weight indexes.
Yes.
I said, if you look at the long-term returns of equal weight, they beat cap weighted hands down. The only caveat being that you have to suffer through some drawdowns that make it so the professional investor can't handle it. You
Right.
can't as a. So I take it you agree with that analysis, and I kind of understand that. What was the insight, and how did you make the leap from the equal weight to saying, oh, you know what, there's an even better way than just making them equal weight? Well, we won't just remove the negatives about cap weighted. Maybe we can actually find something positive to base it upon. Just walk me through that whole process. I'd love to hear it.
Sure. Well, the source of incremental return for fundamental index and for equal weight is the same. They both have a rebalancing mechanism. Equal weight, if you equal weight the S&P 500 today, it's not going to be equal weighted tomorrow. The stocks will have moved. So you have to have a rebalancing discipline to bring it back to equal weight from time to time. And it actually doesn't matter whether it's daily, weekly, monthly, annually, or based on stocks that have gotten twice or half their target weight. However you do the rebalancing, you are rebalancing. You are concentrating against the market's most extravagant bets, against the constantly changing opinions of the market. That's exactly the same thing that fundamental index does. The differences and what makes fundamental index materially better are, one, with equal weighting, what index are you going to choose? You're likely to choose an existing index like the S&P. Well, that index starts with a heavy dose of little companies trading at high multiples. And those usually aren't very good for you. It also includes hardly any big companies that are deeply out of favor and trading at deep discounts and have been kicked out of the index. Yeah. Fundamental index starts by saying, what are the 500 or 1,000 biggest businesses in the U.S. economy or the world economy? Let's start with those. So,
and I'm sorry to interrupt, but how do you define the size? Because most people would define size as market cap, but this is somehow different. How do you define how large a company is?
There's a lot of ways to do it, and the essential element of fundamental index is use any of them or use a blend of them. You could take company sales as a percentage of the sales of all publicly traded companies. So ExxonMobil might be 2% of the sales of all companies, might be 2.5% of the profits of all companies. Book value, it might be 1% of the book value of all companies. Dividends and buybacks, it might be 3% of all dividends and buybacks that are paid by companies. Those are four distinct, very different measures of the fundamental economic footprint of ExxonMobil. And you could argue endlessly about which measure is the best one, or you could just say, I don't know which is going to be best or most important in the near-term future. Why don't I just average them? So if you average those four numbers, 1%, 3%, 2.5%, 2%, you come up with 2.1. All right, there's nothing magic about that being the right number. What it is a stable anchor to concentrate against the market's constantly changing views. So you set it at 2.1, and a year from now, the fundamentals have changed. Maybe it's now 2.2, but the price will have moved by more than that. And so you either top it up or trim it, depending on what the price has done in the interim. And so you're constantly rebalancing. It's the same thing you do with equal weight.
Right.
But your starting universe is a healthier and deeper universe than it is with equal weighting a cap weighted index. The second big advantage is that big companies are usually relatively large cap and relatively easy to trade. So if you're weighting the portfolio by fundamental size of the business, you're investing in stocks that are very liquid and very easy to trade. So when you look at capacity, how much capacity does the strategy have? By most measures, we could handle about half as much assets under management as cap weighted indexing. Equal weighting doesn't even come close. So if there's 10 trillion indexed to US indexes like the S&P, we could handle 5 trillion. Equal weighting would be a mess at 100 billion, which is why the institutional community shies away from it. But you're absolutely right. It's an easy source of incremental return.
Okay, so we've agreed there, and I'm going to go learn all about fundamental indexing because I didn't realize that there was such a thing, and I'm looking forward to learning even more. Let's get and talk a little bit about your views on the market and what you see as opportunities and problems right now. Let's just start with my favorite topic, which is inflation. You've kind of, if I'm not mistaken, you believe that it's not going to recede maybe as quickly as the market expects. And I'm looking at the 1 year inflation swap, and it's collapsed from 6 to 2.5 or something like that in that range. Do you think that the inflation swap market is wrong?
Yes. Now, I will cheerfully admit that I could be wrong, but here's my logic, and it's very straightforward. CPI inflation, 1/3 of it is shelter. Shelter is home ownership or home renting. And back in 1980, when we had inflation crest at 14.7% in March of 1980, the Bureau of Labor Statistics used home prices as a component of inflation. They were horrified that the tail was wagging the dog, that a 20+% run up in a single year in home prices pushed aggregate inflation to 14.7%. So they looked around for an alternative. They reasoned that if you're a homeowner, you don't feel that 20% rise in your home price. You only feel that if you're a buyer right now. But ultimately, you do feel it because ultimately it does, the value of your home does matter on a long-term basis. So they came up with an alternative called owner's equivalent rent. What do? They asked thousands of people, what do you think your home would rent for? If you're like me, I don't have a clue.
Yeah. I don't know how anyone, unless you're renting it, I don't know how anyone would know.
I could make a wild guess, and it would probably be within 50% of the right number, but I'm going to pick a number out of the air if I'm in the survey. And I'm going to anchor on my answer last year. Last year, what did I say? $4,000 a month? Okay, I'll say 4,100. The result is that owner's equivalent rent is smoothed and lagged. Over the last 24 months, home prices are up 39%. Owner's equivalent rent is up 8%, not per annum. That's 6 for the last year and 2 for the previous year. That's 3,000 basis points behind the rise in home prices. Okay, well, what's going on there? The owner's equivalent rent eventually catches up, but it does so over the course of, call it a decade, multiple years. Half of the catch up happens in the first 3 years, which means we're going to see owner's equivalent rent accelerate from current levels by about 5% a year over the next 3 years. That means OER is likely to be high single digits, possibly touching double digits. But I would feel comfortable saying it's going to run at 6 to 9% a year this year, next year, the year after. Beyond that, it's hard to say. Now, that's all assuming home prices don't crash because of what the Fed's doing. But BLS inflation doesn't reflect any of the appreciation in homes that's already happened. So it's miles behind the curve. actual inflation didn't crest at 9.1% a couple months ago. It calculated the way it was calculated in 1980, it would have been 12%. Reciprocally, if you did the 1980 inflation the way we do it now, it'd be 11%. So we're right in line with the record inflation surge of 1980. It's just understated, lagged, and smoothed. Rental of primary residence, called RPR, is similarly a survey. They ask renters. They don't ask landlords. If you ask landlords, what are you charging for this apartment, this type of apartment this year versus last year? The national average is up 15%. In Miami, it's up 41%. Good Lord, 41% in a single year. But the BLS asks tenants, what are you paying? And if you haven't renegotiated your lease, you're paying the same thing you were a year ago. So 0. Okay. That's going to be averaged with some 15%. And landlords, if you've been a good tenant, will cut you some slack. They'll say, why don't we do 10% now and a little more later? So they'll average you in. So you wind up with, again, a smoothed and lagged inflation metric, all of which means OER and RPR are going to be high single digits for quite a while yet, at least a couple of years, unless the Fed blows up the economy so badly that home prices crash a la 2008.
Okay, so let's talk about that, because I think increasingly, and especially with the Powell's rhetoric, and is kind of the new Powell, let's just call him the hawkish Powell, the I want to be Paul Volcker again, the market is becoming concerned that he will push the economy into a recession no matter what. To him, the mistake he does not want to make is become another Arthur Burns, and therefore he will take the economic pain. And the market is increasingly believing that, or at least I would say that the market's increasingly believing that. A, do you believe that? And then do you think then, therefore, the market, even though I would contend that it's getting built in, it's still got a lot more pain to come?
Well, I think he's been relatively clear that he's not going to back off until demand falters. To a person with a hammer, everything looks like a nail. And what caused this inflation was partly demand and partly supply. You had supply shocks. You had challenges on oil and gas exports from Russia. You had supply shocks on chips and other things in the global economy. You had supply shocks driven by COVID lockdowns. And does the Fed have any influence on any of that? No. You also had supply shocks based on the COVID lockdowns themselves, because you took a lot of people out of the labor force, and people who aren't working aren't producing, meaning that supply of goods and services was reduced. But you send people trillions in checks to their home, and they're going to keep spending. So demand was bolstered by the stimulus, and supply was cut by the lockdowns. There's still a fair amount of that going on now, no longer mandated lockdowns, but work from home is widespread, and it's not necessarily clear that people are all working from home. As Elon Musk said, he said you can pretend to work from home for somebody else. So supply of goods and services is diminished, demand is increased. The Fed has no control over any of that, but they can crush demand by raising interest rates. I'm blocking on the name of the economist, an MIT economist back in the 90s, who said it's not that no economic expansion dies of old age. They're all murdered by the Fed.
Right.
And one of our lead advisors, a guy named Cam Harvey, who's a professor at Duke for 7 years, was the editor of the most prestigious journal in finance, the Journal of Finance. And he in his PhD dissertation in 1986, showed that yield curve inversion predicts recessions. At the time of his PhD dissertation, it had a batting average of 5 for 5 with no false positives. Now it has a batting average of 9 for 9 with no false positives. It's a pretty cool predictor. I would argue that it's not a predictor, that yield curve inversion causes recessions. Why does that matter? Why does that distinction matter? Because it implies that you didn't have to have the recession. The long end of the yield curve is set by bid and ask, by the market defining what the long-term risk-free interest rate should be. And by risk-free, I mean free of default risk, no chance of default. That's set by supply and demand at the long end of the curve. The short end of the curve is run by the Fed. And so tacitly, when they push short rates above long rates, that's a yield curve inversion, what they're saying is we want to crush demand. We want to make it expensive to borrow money on a short-term basis to explore new product ideas, to launch businesses, to borrow to buy a new car, to et cetera, et cetera. And I would argue that if the short rate is higher than the long rate, think of the interest rate as your reward for deferring consumption. Your reward for deferring consumption for a year should be a lot lower than your reward for deferring consumption for 30 years. If you own a bond, you're deferring consumption. And so the short yield ought to be lower than the long. And with the September hike, highly likely to be 75 basis points, you finally go to a full inversion where the 3-month yields more than the 30-year.
Yeah, that was going to be my question, because the famous paper that that your friend wrote, it was based upon the 3-month 10-year, right? And
that's exactly right. And everybody now talks about the 2-year versus 10-year. The 2-year isn't short money; it's short-ish.
Right. And the one thing about it is, well, maybe if the bond market keeps crapping like it is recently, we might still not get inverted the 3-month 10-year.
That's although it's possible, but
we're close.
The expectation is another 50 basis points in November, and unless long rates go up 75 basis points between now and then, you will have inversion at that time. So the Fed is dead set determined to push down demand, which is the only thing that they have control over. And I think a more sensible course is to let the long end of the yield curve govern your behavior. If you want to tighten the economy, push short rates up to not quite as high as long rates. If you want to bolster the economy, make it a little bit lower than the long rate. But nobody in Fed circles thinks that way. You've got an echo chamber of people who think almost identically alike.
One of the things I've heard you talk about, I thought was really insightful, was you talked about real rates being a speed bump for the economy. Could you explain what you meant there? And I think that might work well into what we're talking about when you're explaining where you would set rates.
There's a Swedish economist named Knut Wicksell who wrote papers roughly 100 years ago on the natural interest rate. And he basically demonstrated that if interest rates are too low, you are encouraging anyone who can borrow at those low rates to borrow and to deploy that money in whatever pet project they want to pursue. So you wind up with malinvestment, misallocation of resources, zombie companies. A lot of the big companies can access money very cheap and don't have any useful new ideas. So the money gets diverted from good ideas to stale ones. And if the interest rate is too high, then new initiatives get crushed. So this was his work, and he was in a time of the gold standard, so there was no inflation, and real interest rates were real rates. Now you could say exactly the same thing about real rates, that if real rates are too low, and they've been negative for quite a while, if real rates are too low, you're encouraging zombie companies, you're encouraging malinvestment, you're encouraging dissipation of wealth into all sorts of pet projects. And this is not just at the individual and corporate level, it's at the government level, because of course the government can borrow at that rate. So the low rates are tacitly encouraging waste by individuals, by companies, and by governments. It's awful. But flip it around and make it too high, and you crush the economy, which is what Powell says he intends to do. Now, here's an interesting observation. Volcker looked at 14% inflation and pushed the short rate up to briefly 21.5%. Holy moly. We're looking at 9% inflation, which is understated. It's probably more like 11 or 12. But we're looking at 9% inflation and talking about raising rates to just over 3% in a week or so. That's not a Volcker. He's not channeling Volcker. He's talking like Volcker and channeling Burns. So I don't know how this is going to play out. I don't think he's going to be effective at crushing inflation unless he goes too far. And you can't crush inflation without fiscal support, where the government stops throwing trillions of dollars at pet projects. And I don't see that changing anytime soon. We've had bipartisan embrace of modern monetary theory. Trump started it. Biden said, "I'll see your $2 trillion of waste and raise you one." It's very, very distressing. In 2020, when I was giving speeches, I would often be asked about the election, and I would say this is a very consequential election. We have a choice between somebody who wants to run $2 trillion deficits as far as the eye can see, and somebody who wants to run $3 trillion deficits as far as the eye can see. And inevitably, somebody would say, "Yeah, but which is which?" My reply would be, "Exactly."
So I have a question in terms of inflation. And if we sit there and if we buy into the idea that inflation is going to be higher than the market expects, and I completely agree with you there, what's an investor to do? And let's just start with tips. Tips, although at first for a while they seemed to be doing well, they behaved in a strange way during the inflation spike, or at least strange for me. I would have expected there to be more fear and people to price the longer end with higher inflation expectations. Yet all they did really was chase the front end of the curve. So could you talk a little bit about tips, what place they might play in a portfolio or as a trade if you see inflation continuing for years to come?
Well, if you expect inflation to be higher than the market believes, break-even inflation for 10-year tips, break-even inflation for your listeners who don't know the term, it's the difference in interest rate between 10-year treasuries and 10-year tips. And the tips are the inflation-linked bonds. So if you have one of them yielding, if you have the bonds yielding 3 and the tips yielding 0.5%, the difference is 2.5. It means you would have to have 2.5% inflation for the tips to earn as much for you as the bond. Well, right now that is the break-even inflation rate. The tips are yielding almost exactly 2.5% less than the Treasury bonds. If you believe that inflation will be higher than 2.5% over the coming 10 years, then tips will perform better.
Okay.
Guaranteed. No ifs, ands, or buts. It will perform better. If you're wrong and inflation is lower than 2.5, the bonds will perform better and the tips will be a big disappointment. What happened between March and this quarter, March, the break-even inflation rates peaked at 3.1. The market was expecting 3.1% inflation for the coming 10 years. Powell's rather aggressive saber rattling about raising rates until, regardless of the consequences for the stock market or the economy, until inflation was under control, rattled the bond market. The bond market year to date has performed worse than the first 8 months of any year in domestic U.S. bond history. So the bond rates have soared, but his saber rattling about getting inflation under control has been persuasive enough that people believe he'll succeed and believe that the average inflation for the coming 10 years will be 2.5%, not 3.1. So that move from 3.1% in March as an expectation for inflation to 2.5% today means that tips performed dreadfully. Right. Their yields went way up. Their prices went way down. If you view things as a short-term speculator, this sort of thing hurts. If you view things as a long-term investor, well, this is cool. You've got an ability to buy inflation protection at effectively a 2.5% price. And if inflation is higher than that, you're going to earn a higher return.
Are you surprised that it's 2.5?
Yes.
I am as well. What do you have any theories as to why that is?
I think people don't understand the nature of BLS inflation and think that the inflation is moderating. You have some very fast-moving short components like gasoline prices that have tumbled since their April highs or May highs, and that's a fact. But the cost of where you live, the cost of heating your home during the winter, these are all going to be way up from a year ago. And so the true underlying inflation is a lot higher than what's been reported. I think people just don't understand those nuances. I've talked to Fed watchers on Wall Street, and these are folks making 7-digit incomes for prognosticating. And I remember one of them earlier in the year saying owner's equivalent rent will be back down to 3% by the end of the year. Huh?
Yeah.
So you've got a widespread view that is unduly simplistic, that pays attention to what is perceived to be the nature of inflation instead of digging into it and understanding the nuances.
Okay, let's move on to the idea about value and growth investing in factor investing. One of the things that I saw you talk about the other day that I found just illuminating was your insights into the idea that higher interest rates necessarily mean that value will do better than growth, and the whole relationship. And I'd love if you could just repeat part of those things and walk us through all the things that we all have taken for granted, in that like higher rates, it's bad for growth, and just give us some insights there, because I loved hearing it.
Sure. What we find is that high or low interest rates has very little to do with whether value or growth is winning. The narrative is really simple, and that is growth stocks have most of their future earnings way out in the future. Value stocks, their earnings could falter. So the bulk of their success is coming in the next 5 or 10 years because the business is in decline. And so low rates mean that growth stocks are worth a lot more than relative to value than when rates are high, because you're discounting. Very low discount rate means that future growth is much more valuable. All right, that makes sense. It's based on something known as the Gordon equation, which says a stock is worth its profits divided by its future growth discounted at some sort of discount rate. And that future growth is tied to the interest rates. So if you assume that the interest rates are going down, then the value goes up for value and for growth, but more so for growth. But if you assume that higher interest rates go hand in hand with higher growth rates, then you're discounting, then the linkage cancels. That is to say, the growth rates will cancel the lower discount rate. Now, how does this play out? If you look at a company that has rapid expected growth and you're discounting at a higher rate, it's worth less. But if it's presumed to grow more, it's worth more. And the growth and the discount rates are linked. The very low interest rates of the last decade have gone hand in hand with very low growth rates. And that's something people overlook. I'm not saying the Fed raising rates is going to raise growth. I am saying getting rid of negative real rates will raise growth. The underlying driver for that linkage with interest rates, which empirically is a very weak linkage, if you look at it internationally and across past decades, you find that it's a very weak linkage.
Because otherwise Japan would be the...
Right.
Yeah.
Right.
Meanwhile, their stocks are doing terrible.
Yeah. And pardon me, but do they have a growth sector anymore? The FANG stocks are all U.S. based. Well, the U.S. was late to the negative interest rate table, late to the zero interest rate table, and didn't stay there as long as Japan or Europe did. In fact, I think it's quite hilarious. Christine Lagarde, when she announced that they were raising the central bank interest rate from -0.5 to 0, said, "We will do whatever it takes to bring in this inflation under control." Inflation was 9% and she was raising rates to 0. What? Anyway, the underlying driver for interest rate movements to some extent is inflation. If inflation is elevated, you're likely to get higher rates. And so if you look past the rates and look at the linkage with inflation rates, you find a much, much stronger relationship. That is to say, high inflation is much worse for growth stocks than high interest rates. Now,
Okay.
why would that be? Think about it this way. There is no such thing as high but stable inflation. It doesn't exist. And if there's no such thing as high but stable inflation, when you have high inflation, you have instability, difficulty to predict what's going to happen in the economy, difficulty predicting economic growth and growth in demand for your products and so forth. In that circumstance, isn't it nice if every $100 you invest, you're buying a more reliable and impressive earnings stream? That's a value stock. A larger book value of the company, that's a value stock. More sales per $100 you invest, that's a value stock. So you're buying companies with low price earnings, high dividend yield, low price to book, low price to sales, value stocks. Why? Because during periods of economic uncertainty, these companies have a foundation to protect you on the downside. And that's the reason that value stocks relentlessly outperform growth during periods of inflation.
So,
So,
sorry
yeah.
to interrupt, but given your outlook for inflation, do you believe that we've entered into a secular bull market in value, and that this is just the start? Because although we've had 6 months of an uptick in value over growth, it paused a little bit. Is that about to run again?
Well, firstly, it's not 6 months; it's 2 years.
Okay.
The trough was end of August of 2020. Value rebounded sharply over the next 8 months, then sagged through year-end 2021. Kind of made a double bottom, but the bottom at the end of 2021 wasn't anywhere near as low as the 2020. And then the snapback this year has been impressive. So I think we're 2 years into a multi-year bull market for value relative to growth. The time when you'll know it's over is when everyone thinks that you have to be an idiot not to be value investing.
You're absolutely right. There's nobody's even doing it. I have a good friend that's a hedge fund manager, and he tells me that when he talks to the institutional allocators, he says that they're just starting to recommend, instead of going with the growth guy, moving on to the value investor. And he said when these trends go, it doesn't turn around in a year. It's a 5-10 year long process, and we're just early in it.
The tech bubble laid a foundation for value to be abnormally cheap. Value stocks were about 1/8 as expensive as growth stocks measured using price to book. And they went on over the next 7 years to be roughly 1/4 as expensive as growth stocks. Well, that's a doubling. That's 100 percentage point outperformance for value relative to growth. That took 7 years. And then we were in a situation in 2007 where value managers were the hottest, trendiest places to invest. And that set the stage for a 13-year bear market in value relative to growth. Now, all of this is based on the classic academic definition of price to book. If you use price to sales, a new high was reached in early 2017. And so it's really just a 4-year bear market, not 13 years. But be that as it may, it was a horrible rout for value investors from 2017 to 20. The snapback has been well over 2,500 basis points for value relative to growth. And yet people are only just now starting to say, oh, maybe I need some of this.
Right. Do you think that we could get a situation where, like, you're talking about that on a relative basis, and you're saying that this, as a percentage of price to book versus growth, is going to increase? One of the worries that maybe some investors might have is that they're not treating that on a relative basis. They're just going to be long one or the other. Could you foresee something where value goes sideways and everything else just kind of skids lower over the next couple of years?
That's actually exactly what happened in 2000. People think the bear market, the market crested, depending on which index you were looking at, either at the beginning of 2000 or in August of 2000. But either way, it was a peak in early to mid 2000, and the market cratered, hit low point at through September of 2002, 2-year or 2.5-year bear market, brutal, down almost 50%. That's what people see. Dig down, and what you find is that if you just equally weighted the Russell 3000 stocks, equal amount in all 3,000, the market was up in 2000, was up again in 2001, was up again in the opening quarter of 2002, and finally crested in April of 2002, up almost 20% from the start of 2000. So you had a bull market in the average company that continued for 2 years. Nobody noticed it because the big indexes are cap weighted, and the big high flying tech stocks were utterly dominating those indexes. And so by the end of the first quarter of 2002, the S&P was already down 20%, and the equally weighted Russell 3000 was up 20%. Really fascinating.
Rob, I got so many questions, and I feel like I could go on for another hour, but I better be bringing this to a little bit of a close here because we're an hour in already. And so I'm going to, for the last market question, I'm going to ask you, what and when is peak fear?
I think that the time to buy an asset is when fear is at its peak. What do I mean by that? The markets are priced based on narratives. People will say, don't buy Europe. Look what's going wrong in Europe. Everything's going haywire. You might have good German citizens freezing to death this winter because of the sanctions on Russia and the closure of the Nord Stream pipeline. And that's the narrative. Okay, but the narrative is in the price. How many people haven't heard that narrative? How many people are unaware of that? It's in the price. The price already reflects that. So what you want to look for is narratives that are going to change. That narrative is going to be escalating. That is to say, fears are going to be escalating as winter approaches. It's Game of Thrones and winter is coming. And winter is coming. And there's the brinksmanship between Europe and Russia on energy supplies is only going to escalate. And so you're going to reach a point probably in the next couple of months where the fear that Europe's economy is going to be pushed off a cliff and people will be dying because they can't heat their homes, that fear will be elevated even from today's levels. Is the reality likely to be milder than that? Yeah. People have coats. And there will be people, fragile, elderly, people living alone, where horrible things will happen. But it's not going to be thousands of them. It might be dozens. It's not going to be thousands. And so the reality is likely to be far less bad than the current narrative. Narratives set current prices, changes in narratives move markets. And so I think we're actually approaching a point of peak fear for European stocks. And I think it's going to be really interesting to not try to gauge when things are looking rosy for Europe, but when things are looking at their absolute bleakest, because that's when you want to buy.
That's a great way of explaining how markets are forward discounting mechanisms. And I always try to tell people that, you have this idea about what's the, either a bullish or bearish narrative. And then you say, that's great, but you really need to know what's in the price.
Right.
And this line about narratives set current prices, but changes in narratives move it. I'm putting that into the database of wise lines that I'm going to keep and repeat. Okay, Rob, let's go to end with the questions that I ask all our guests. We're going to start with your favorite investment books.
Some of there's a lot of great investment books out there. There's also a lot of crap. But, Peter Bernstein is probably my single favorite author. He died, I think, about 10 years ago, but he has a way of writing captivating books on arcane subjects. So suppose you're a publisher and Peter Bernstein walks into your office and says, I got a great idea. I want to write a book about the history of risk and uncertainty and how we understand risk and uncertainty. And I'll talk about the math, the innovators who came up with the math of Risk and Uncertainty, and it'll be a New York Times bestseller. You'd roll your eyes and say, what are you talking about? Well, that's the book Against the Gods. And it was a New York Times bestseller. And it's a wonderful history of risk and uncertainty, which is arguably the most important thing to think about in managing money. Anyway, Bernstein, anything by Bernstein.
And Against the Gods, a remarkable story of risk. It's funny because I'm just looking at my desk here, and I got it right there, sitting there in my books that I have that I would like to reread. It's a wonderful one. Let's go with the next one that I always think is interesting. Are great traders or investors born or made?
A bit of both. I've met investors and traders who were instinctively contrarian. One of my early mentors was an instinctive and very curmudgeonly contrarian investor. They're made also. I'm not contrarian by nature, but I'm a contrarian when I use quantitative tools to help me do what's uncomfortable. Oh. And so training yourself to learn from your mistakes, I think, is one of the most important tools in evolving as an investor. Just when you make a decision, jot down, what did you decide? What was your rationale? And when you decide to unwind that investment, look back and say, what can I learn? This investment was successful or this investment was unsuccessful. What can I learn? And you learn a lot more from your mistakes than from your successes.
All right. One of the famous Canadian strategists is a fellow by the name of Don Cox, and he always says that you should invest not based upon what's on page 1 of the paper today, but what's on page 19 on its way to page 1. Very much what you were talking about in terms of your philosophy. Do you have a Don Cox investment idea for us?
Firstly, an observation on that. A friend of mine, Charles Gave, is a brilliant French economist, which sounds like an oxymoron, but it's true. And he likes to say, when he's reading the newspaper, he likes to say, what are these bastards trying to distract me from?
Oh, that's a good line. I like that.
And I think that's a fun way to think about it. I wrote a paper back in 2018, I think it was, entitled Nowcasting, in which I pointed out that a lot of punditry will talk about something that's already happened as if it's a forecast. And when you read what they're saying, you can ask yourself, is this something that's already happened? Are they just explaining why what's already happened? And if so, it's a nowcast. It's not useful. It's not a forecast. But if you are a nowcaster, people will remember your forecasts as if they were forecasts, not as if they were nowcasts. And you will be right far more often than you're wrong.
You're going to expose all the nowcasters.
So when I look at news reports, I always ask myself, is this nowcasting or forecasting? Is this something new that is not already well known to the market? And 99 times out of 100, it's already well known. It's almost never something truly new. But if it's truly new, it's not likely to be page 1. Right. So I do like news clipping services that dig for the obscure stuff that's largely overlooked. Jim Bianco has a wonderful clipping service out of Chicago. And so, Cox's insight is a very sound one. Whatever's on page 1 is already in the share price. Pay it no attention unless you're wanting to bet against it.
All right. We're going to end with the last question, which is, if you were to give a young person starting in this business today some advice, what would it be?
First, most importantly, be endlessly curious. When you're told something that sounds reasonable, something about the way markets behave, something about the way investors behave, ask yourself, is this true? Can it be demonstrated? I think I've made a career of testing hypotheses that are advanced as facts and finding some of them are true and some of them, lots of them, aren't. And so I publish an article saying the king has no clothes, the emperor has no clothes. And it's taken me a long time to get used to the fact that that makes a lot of people very, very angry. The anger I always find fascinating. But it's really a matter of always be curious. Ask, why should it be the way these people are describing it to me? And secondly, early in your career, don't pay too much attention to what you're getting paid. Pay attention to what you're learning. My first job, I took the one that offered the lowest pay because they were going to give me a day a week to do research and study markets. I'm not saying go for the lowest pay offer you get. I'm just saying early in your career, it doesn't matter that much what you make. What matters is what you learn.
Yeah, that is great advice. Actually, my father gave me similar advice when I had come back from a stint on the Chicago floor, and I was trying to get a job at in an institutional firm, and I had two firms I was going to work for, and one of them was RBC, and it was a great place. It was like the Goldman Sachs of Canada in terms of, and there was another one that was that had fancier computers. It seemed like it was more exciting and stuff. But my dad always said, you take the job at the good firm where you're going to learn the most. And when they ask you how much you want to be paid, you tell them that you'll take whatever they're giving right now, but when you hopefully contribute to the firm, that you'll be compensated adequately. And it was some of the best advice my old man ever gave me, because within a couple of years, I was, let's just say that the starting salary was a rounding error.
Yeah. If asked, what do you want to get paid? Your dad's advice was good. I often think back to when I first started, and wouldn't it be fun to say, well, in 10 years, I want to be making $1 million a year, but for now, pay me what you think is fair.
That's right. Very, very close to what my old man was telling me. All right, Rob. So listen, why don't you tell people that are interested in learning more about your papers, your strategies, you all the different things, and like how they can invest with you, a little bit more about your shop and yourself.
Thank you. Well, firstly, our website, researchaffiliates.com, has all of the papers we've written. There's about 400 papers in the last 20 years on that website. I'm not suggesting you go read all 400, but get yourself on the distribution list for our pings when we come out with a new paper. A couple times a month, you'll get a ping, and if it sounds interesting, take a look and read it. In terms of investing, we're best known for our work in global asset allocation with PIMCO, the all asset group of funds, and for our work in developing the fundamental index, which is run by Charles Schwab, has about $45 billion in fundamental index ETFs and mutual funds. Just look for Schwab Fundamental Index. Invesco has ETFs in the same arena, slightly different strategies, but both very, very solid. And PIMCO also has active versions of fundamental index-based strategies that add a quality filter and a momentum filter to try to eliminate value traps, and those are called PIMCO RAE. So any strategy that's PIMCO All Asset, PIMCO RAE, Invesco, RAFI, Schwab Fundamental Index, those are our strategies. And what you'll find is that for the most part, they do awfully well against their benchmarks. And particularly on the equity side, awfully well against value indexes. And if you think value is the place to be for the coming decade, boy, if you can beat value, whether it's winning or losing, which is our historic norm, being able to beat value when it's winning is likely to be a very, very nice home run.
So I have one quick question. Did you ever convince Jack Bogle to invest in any of your funds or your strategies?
He really liked, it's interesting. He was absolutely brilliant guy and a wonderful human being. He was also acerbic in his judgment of ideas that weren't his. So ETFs, it's giving kerosene to an arsonist. Okay, so how big a difference is it being able to trade once a day at the close, your mutual funds, versus intraday with a relatively tight bid-ask spread, ETFs? It strikes me as difference in octane level of fuel for, if you're an arsonist, you can hurt yourself badly with both. And the fundamental index idea, which is what I was talking with him about, he said, why would you do that? It's just a value tilted strategy, and it's you can have less turnover and lower fees by just matching the market. So he was dismissive, but he was also a brilliant guy. And I was never offended at him being dismissive because I knew he was dismissive of 99 out of 100 ideas.
That's right. As I say, the only thing that would have excited him more was to get the fees down. He was convinced that fees were the real killer.
Yeah.
Anyways, Rob, I thank you so much for your time. It's been wonderful. I have like another hour or two questions for you. We'll have to save it for another time. Thanks again. So for those that are interested, it's researchaffiliates.com. Is that correct?
That's correct.
All right. Go check it out. Go sign up for the papers. Go have a look at the different products. Thank you again, Rob.
Thank you so much. This was a lot of fun.
It's our great pleasure to welcome back to the show. You know, it's that time of, I guess that time of year again, the quarterly appearance by Brent Kochuba from SpotGamma. Brent, thanks for coming again.
Thank you. I love being here. Love talking to you, Kevin.
And it's a great time. And the reason we get you on quarterly is because, you specialize in options and we're approaching expiry. And we like to get you a couple of weeks before expiry because there's often a lot of fireworks in these last couple of weeks as positions are moved around and different things. And you brought a little bit of presentation here. You called it Pulling Forward the Rally Fuel. And we're going to go through it here and talk about what you're seeing in the markets and how you see this lining up. So let's just start with your first slide, which starts on page 4.
Yeah, I got to skip the disclaimers and all that. So good man. Yeah. So as you noted, I've worked in a good business for myself that this happens 4 times a year. So you're forced to talk to me that many times. But the positions are big as they usually are on these quarterly options expirations, and I think what's kind of fascinating is you and I have been talking about this for I think coming up on 2 years, maybe 3 years now, right? And originally it was convincing people that these options expirations, particularly these quarterly ones, can matter. And now that's a little more kind of standard news. Do you know what I mean?
Yeah, I completely agree. I completely agree. We had to convince them first that he was even moving it.
Yeah. And so now what I got to try to convince you of possibly today is that I don't know if this stuff now just gets sort of front run a little bit, but what's happened over the past week here, we've had a tremendous rally in the S&P. I think we're up, 3-4%, something like that this week, really even just in the last 2 days. And I think a lot of that is driven by this upcoming expiration. And that's why I called this presentation Pulling Forward the Rally Fuel, because the first slide here on the deck, what it shows is the size of the delta notional for puts and calls. So puts is kind of that dark blue line and calls are the dark blue line and then puts are in teal. And what you can see is that we have pretty equal amount in delta notional exposure right now for puts and calls. It's about 300 billion. That's a lot. It's a big position, but obviously this is not to say that this is the absolute exposure of dealers, because a lot of this nets out and different things like that. But what's so fascinating about this is that this exposure is like half the size of what we had just last Friday when the market was a little chippier, right? We were down around 3,900 in the S&P, and things were looking a little sketchier. And so if you kind of put yourself forward one more slide, I just want to set the stage here. Many of you who have heard me talk before, Kevin, you've certainly heard this before. These quarterly options expirations can be really big turning points for the market, and options expirations this year in general have been really important. So in these orange arrows, I've marked just regular monthly expirations, and then the two black arrows you can see here are monthly expirations. So if you look at where we were in and around the March lows, that was the week into FOMC, which happened first, and then we had OPEX on a Friday, and the market rallied, depending on where you want to strike your low, somewhere between 7 and 10%. It was 7% from the low to the March 30th high, but overall it was about a 10% move. The Fed kind of juiced things a little bit before, and I think, again, pulled forward some of this OPEX rally fuel. So you had a big 7 to 10% rally then, and then off of these June lows, it was a little chippier. We had an initial, I think it was about 7% rally. We pulled back some, and then we rallied about almost 20% into August expiration. Incidentally, the high in August was, I believe it was the day before August options expiration, and then we slid kind of violently lower into last week. And so now we're a week away from September options expiration.
Okay. Now, just wait. I guess I'm a little confused. Are the black ones are the quarterlies, and the orange ones?
Yeah. So I should clear up the semantics here
Yeah.
a little bit. So when I'm referring to a quarterly expiration here, I'm talking about the expiration, the third Friday expiration that happens in March, June, September, and December. So there's an official quarterly expiration that actually occurs on March 30th. But those expirations, there's really one big trade people like to talk about. That's the JP Morgan trade.
Right.
But in terms of the real notional size, that is almost always baked into the third Friday of the quarterly months, right? So again, the third Friday of March, the third Friday of June, and the third Friday of September and December.
Now, and could I go back a slide to
Please.
the notional, and let's just talk about that. And I think you mentioned the fact that the notional has come down over the last.
Yeah. So advance me one more slide quickly here, and I think
Okay.
it'll snap into place. I
there
kind
we
of was
go.
trying to make it a little more dramatic here. So if you look at the,
it would help if I looked forward on the slides and knew that was coming, Brent.
how dare you? Yeah. So what we see here on slide 6 is the delta notional as of last Friday. We had 900 billion in puts and 470 billion in calls. This was as of last Friday.
Okay.
So over this last week, right, it's been destruction of the put complex, and that's a function of time passing, S&P rallying, and vol coming down, and then calls have actually drained out a little bit as well, right? We've dropped out half, and again, there's some decay in there, obviously, and vol coming down affects that position as well. So over the last week, there's been a major, and this is again back to the sort of title of the presentation, pulling forward the rally fuel. I've been looking around here the last couple of days at the market rallying, and I don't think there's really a great reason. Like, people are flailing around for a reason for why the market is up so much. In fairness, I didn't think we were going to extend this far today, but when you look at these numbers, right, these are very large numbers, and the change in these figures does sort of lend to this idea that we're getting put destruction. And I can explain that if you want. But
Sure.
That put destruction that helps.
Yeah, tell us what that means. It sounds ominous.
Well, I mean, we've talked on this certainly on the conversation here. But if you're kind of new to the idea, it's that if dealers are in general, right, on net, they're short put options, they need to be hedged by selling futures, right, to protect themselves. So that way, if the market goes down, if they're losing money on their short put position, they're making it up when futures drive lower, right, for short puts. And so as time passes, particularly as we get closer to these big expirations, those put values naturally decay, right? That's the theta. Right. If the market rallies, goes higher, well, then there's deltas. Those are positive deltas, right? That puts will lose value. So market makers and dealers can buy futures back because of that. And then the third sort of leg of that stool is volatility coming down. If implied vol comes down, and we've seen the VIX drop pretty sharply here over the last couple of days, that is another way to destroy put values. So right. All three of those, time passing, market rallying, vol coming in, lead to dealers, enable dealers in theory to buy back futures and for the market to rally. Now, obviously, there's some traders that are shorting puts, and there's people who are buying and selling calls. So, what we're looking here is for the fat pitch. And when you look at this giant put position of estimated 900 billion of max value, right, and that shrunk down to around 300 billion, we go, okay, clearly there's a lot of just puts have lost a ton of value. The other thing to note here is that, yes, some of the positions could have certainly been closed, but the big positions tend to be held into expiration when you consider the strategy of large hedge funds.
And for those that are interested, when you see on Vol Twitter, you see people talking about Charm or Vanna. That is what Brent just so eloquently described. Charm meaning the change in delta based upon time, and Vanna being the change in delta as a volatility changes and it goes lower. It ends up being that they have to buy back more futures. Okay, so we've said that is the case. Now, do you like? Let's talk a little bit about this. Usually this is something we would expect to see next week.
Yeah, I think generally you would expect to get that next week. And I'm going to touch on this a little bit towards the end, but I wrote in our sort of daily note that I felt that the amount, the rally, right, and the amount that vol would come down, there's a limit to it because we have a couple of big catalysts coming up. And particularly the CPI next week. We have the FOMC the week, a couple of days after OPEX. And then we have a pretty big VIX expiration on the 21st. So the 21st is a big date, because of FOMC and the VIX expiration. So in my view, it's sort of like the CPIs recently have been almost as big of a data print as the FOMC rate decisions, right?
Oh, yeah.
People have been hedging these. It causes a tremendous amount of volatility. And we have one of those coming up on the 13th. And so my general viewpoint here was like, look, if you care about that date, you maybe want to hold on to vol or hedge yourself past that date, but maybe these next couple of days, particularly once Powell, gave his little speech at the Cato Institute, nothing came of that. Maybe I could just sell today's vol, sell Monday's vol, sell Tuesday's vol, whatever. That's giving me sort of this pass to just sort of smash volatility. And once you get that feedback loop started, right? Once the market starts to draw up and vol starts to come down, it becomes that self-reinforcing feedback loop, right? Because as the market goes up, dealers can buy more futures because their puts have been destroyed. Well, that forces the market higher, which allows them to buy even more futures, right? So this is the negative gamma feedback loop that we often talk about. And just this idea in general that, we're exposed to these big violent trends. And so this is the rally field that we're pulling forward in my view right now, right? This
and you would have,
loop.
sorry to interrupt, but you would have thought that with the CPI that they would have held off. And yet they started early.
That was sort of my view, exactly. And I said, look, there's nothing to stop us from having a pretty sharp rally here. And, we thought that specifically 4,000 would kind of cap the rally. And I honestly, I'm not buying into this rally because of the fact that I think it is positionally driven. So we talk about this positional analysis and the idea here that this is put rally exacerbating this move higher. And you're not going to want to have the same position as you approach the CPI. Now, if the CPI is market friendly and people like it, then okay, we're going to continue rallying, obviously. But this rally, I think, is very unstable because of these positional dynamics.
Right. And if you think about usually when you have a big number like a CPI, they rally volatility into the number, meaning that everyone's worried about it and they're paying up for volatility. And then what you get sometimes is the relief kind of rally in delta and the decline in volatility, because no matter what, it doesn't end up beating kind of the worry. And so your argument is that maybe that relief kind of sigh that we see on the other side of most big events won't be occurring as sharply as usual because we've actually experienced it now.
That's 100% right. So, there's a few other slides in here that sort of are actually just touched on it, right? How big the rallies were in March and June. So if we've already rallied 4 or 5%, well, what's kind of the top end here? I don't see a whole lot of calls coming into the market. There's some macro, clearly a whole lot of macro catalysts. The dollar's down a lot today, and I think that's causing, some risk assets in general to rise. But if you look at the quality of stuff that's rallying today, like the meme stocks are up 9%, and some of this really kind of like it speaks of a short cover rally in some ways, and not a higher quality rally. And so, again, that catalyst hasn't occurred for the market to rally really here, right? If the Fed said 50 bips, That's all I'm going for. Then you say, okay, well, there's a macro reason for this to happen. And I turn the table to you, I guess, to ask you, like, I don't see a catalyst other than this positioning. And it seems to me like the real triggers would be next week or the week after.
Yeah, well, to me, it feels like there's just so many people short, or at least underinvested or cautious. Different ways of expressing it, but the reality is there's very few people that are bullish. So therefore, this could just be, I don't know, maybe some pulling off of that embedded short position, and then it's as you mentioned, it's created the feedback loop with lower volatility and going into it. One of the things that sorry, go ahead.
No, I didn't mean to cut you off there.
No, it's all right. What's up?
I was going to say, we saw a similar rally in March, right, where we got a big rally the week before OPEX, and we kind of gave it all back up on Monday and Tuesday. And then there was a Chinese stimulus, and then the Fed came out before OPEX, and we kind of re-rallied. So, I put on Twitter this morning, I was like, this is not stable. And, of course, the market proceeds to go up, 20 or 30 handles in my face when I say that. But, I wouldn't be surprised at all. Say on Monday, we just puke all this back, right? And that doesn't mean that we have to start a new bear market, but when I say these things aren't stable, it's all just jumpy. We could easily give back 1.5% here that we just put on.
Well, and I would agree with you there that the market is definitely feeling way more skittish, way more, let's just say, I remember Doug Cass used to talk about the market has no memory from day to day. Seems like one day you get up, everyone's bullish, there's reasons to buy it, and then the next day everything's terrible, China's locking down, and it's really being choppy. And I would agree with you there. And speaking of choppy, let's go to this realized vol chart. What are you trying to show there?
Yeah, so this chart actually comes from the S&P Global. So this is from the mouth of the beast itself, so to speak. And this is 1 month S&P realized volatility. And I had a conversation with somebody the other day, and we were talking about the MOVE index, which is the bond VIX, and I have a slide on that. But we're talking about how elevated that is, and that if you look at the vol complex in general, the VIX is arguably just fairly valued in and around 20. Right. And if you look at 1 month realized vol, it's at 20. But on this chart
One second, before you talk about this chart, why don't you tell people what the difference is between realized vol and implied vol?
100%. So realized vol looks at how much the market has moved over a given time frame. So typically, like on your chart here, we're looking at 1 month realized volatility. So that tells us how much has the market moved over the past 30 days. And again, that's a rolling window. Implied volatility is a forward-looking measurement. And the key difference here is that generally, the low and implied vol is going to basically be where realized vol is, right? Because you're going to say, well, what's about to happen in the market? Well, what has been happening, right? Those two are just as a general basis for starting. Now, obviously, implied vol includes what traders' expectations are. So if I think a Fed event is coming out, then implied volatility is going to be higher because I know that event is coming. So that means that I have to price that in, right? That's a catalyst for volatility. So implied volatility holds in some of sort of the feelings and emotions and thoughts of what traders think will happen, baked into and on top of what has happened.
Okay.
And that can adjust very quickly, whereas realized volatility is only going to measure the last 30 days. So that tells us, again, what the market has been doing. So I would say for purposes of this presentation, realized volatility tells us how much volatility is currently in the market, right? And I can use that as my barometer for how much market volatility is expected or implied.
Okay, and so this chart here, the S&P Global chart, it's showing that we're roughly around 20, which is roughly around where VIX is. So that's the argument that we're pretty well in line with what realized vol has been. Yeah,
and what I find so fascinating about this chart is if you look at that red line, I just drew this dirty red line kind of across the middle of the chart, very unscientific. You can see that we're at this kind of baseline of realized volatility, sustained realized volatility that's higher than at any point in the last 10 years. Yes, we've had a few episodes, 2018 crash, Volmageddon, March of 2020, where we get this kind of episodic spikes higher in realized vol because the market is crashing, limit down style crashes. But very quickly, that realized volatility has reverted back, right? Market calms down very quickly. And I think historically, that's because the Fed has been accommodative. I mean, in this 10-year period, generally the Fed put is in place, right? And again, this is your territory more so than mine, but now we don't have that same backing from the Fed. And I think it's a fascinating note here to say that has brought a sustained period of realized volatility that we've not seen in I don't know if you want to call this a generation, but at least a couple decades.
That's a great point that I've never thought about, Brent. And what's fascinating about it is two things. First of all, that if you would have said this, you would expect the VIX to have been one of the best performing assets out there. And in fact, it's not performed that well at all, and it's gone nowhere. And I guess that's because although realized is high, nobody's really paying up for it, meaning nobody is pushing that higher. Then the next part about it is that although it's sustained and staying up here and sustained, we're so used to these spikes that it feels like it's not that high, right? Like right now you say 20 and then people go, oh, it's only 20. It doesn't feel that high. But the reality is this is a great chart. We're actually in a new regime of the last 6, 8 months. Basically all of 2022 has been some of the most consistently, let's just say, non-crisis volatile moments that we've had.
You put it very eloquently there. And what's interesting is you see that the realized vol increased really at the end of 2021. And I unfortunately forgot to put the chart, or I just thought I should have included this chart. If you look at liquidity in the E-minis, that's the kind of global benchmark of U.S. futures, equity futures, liquidity really started to drain out in that product around the same time. So I think when the Fed started to jawbone about raising rates kind of at the end of last year, end of Q3, I guess, early Q4, that I think a lot of people really did get the message and started positioning for it.
Yeah. Now, this next slide, the VIX normalized to realized, I think this is great because this is showing what you just talked about, the difference between realized vol and implied future vol.
Yeah. So the VIX, for those of you who don't know, is based on it's based on the S&P options, right? So all S&P options that expire within the next 30 days. So it's roughly a 1 month view of S&P volatility, implied volatility, right? So what are we looking at going forward? What are traders expecting in the S&P 500 over the next month in terms of volatility? So all I did here was I subtracted S&P realized vol from the VIX. So I took implied volatility for the S&P, subtracted from realized, and that spread is interesting. There's a few times where you get these major dislocations where realized vol is way above where the VIX is, and that generally happens because traders can say, okay, the Fed came out, they're going to back us up here. We can sell volatility because we're not worried about the market going to world's end. So that's why you'll get sometimes realized trading or realized calculated over the VIX, right? And those tend to last for very short periods. But as far as that VIX normalization concept that we were just talking and realized vol being over 20, if you look at the spread here, you could argue that the spread between the VIX and realized vol looks pretty much right in line with where it's been over the last 10 years, right?
Yeah, but it may be a little tighter, wouldn't you say? Well, I guess,
there's a small, it's certainly a little bit tighter, if anything. And what we're seeing on the chart here is there's a small premium, and you'd expect this. The VIX trades at a small premium to 1 month realized volatility. And that just makes generalized sense. That's sort of the normal thing because, okay, again, my future expectations of volatility should be what has happened in the market. And then, there's the inevitable oddball thing that happens where I got to prepare for the Fed or viruses or whatever the heck is going on. So I'm going to keep a little extra premium there, right? Because
and not only that, the dealers that are doing this, that are selling most options, because let's face it, a lot of them are dealers that are selling to clients that are looking for hedges. They need to get paid. And so they're not going to they're not going to systematically sell it at fair value. They're going to wait for it to get above fair value to sell it.
100%.
Yeah, that's a great chart. It's fascinating, and I still can't. I think that insight about the fact that realized vol is being elevated is something that not enough people, or at least I haven't heard a lot of people talking about, and I think that it makes a lot of sense, and it's really indicative of how the atmosphere has changed in the stock market. Now let's talk let's go a little bit and talk about VIX futures and the term structure here. So let's start with, why don't you tell people what VIX futures are, and then what the term structure is, and then tell us maybe what you're seeing in terms of how it's setting up.
Yeah, so the VIX futures allow you to basically sort of invest purely in volatility, right? So if you think that S&P is going to crash and that the VIX is going to spike, you could buy VIX futures as a way to express that. And now the VIX futures settle once a month at wherever the VIX index is, right? So wherever the VIX is on settlement date, which in this case will be on September 21st, that front month VIX future will settle at that price. So the two meet. And generally the curve or this term structure is in contango, meaning that farther dated VIX futures trade at a premium to closer dated VIX futures. And that makes sense because out in time, there's more uncertainty, right? I'm less sure of what could happen 3 months from now than of what could happen a month from now. And so when you look at this term structure and the movement of it, you get an idea for how traders are pricing volatility. What, are there risks in the market they're worried about? Are there events, et cetera? And so what I've plotted here is the VIX term structure from August 17th, that's just about a month ago, when things were hunky-dory, right? We're at 4,300, which was a recent high in the market. We were just before OPEX. People were being lulled to sleep by volatility. So that's my kind of clear blue sky, day for recent memory or for recent markets. And I just compared that to what the term structure looks like today. Now, the term structure from just a few days ago has come down substantially with this market rally. And as you can see here, there's still a little spread, right, between the black line, which is today, and the all clear blue sky reading, which is in the blue line. And the idea here is that is probably reflecting this volatility premium that traders want to hold because of CPI reading and particularly the Fed. This is the event volatility we talk about. I don't know what the Fed is going to do. Maybe we get a blowout print on the CPI and the market crashes where it may be. I don't know. So I got to hedge that a little bit, right? I don't want to be short vol into those events. So again, there's that volatility premium. So, if you want to think about that Vanna trade, right, in a way, if that spread collapses, right, the black line collapses down to the blue line, or we go back to where August vol was trading, that's just more fuel for the market to rally. And so even though we've had this big rally, I took the snapshot just before we started talking, there is still a little bit of a vol premium here, as we discussed, should make sense given that that CPI comes up next week.
Right. Now, let's get to the next slide because this is interesting. You mentioned it before, the MOVE index. Why don't you explain to people what it is and why all of a sudden we're all talking about it, whereas a couple of years ago, no one knew what it was, and we definitely weren't talking about it.
Yeah, and I've been talking about this for quite a while. I talked about it with you and some smart macro guys as well, Darius Dale, for example. And I just said, look, as an equity options guy, can I use the MOVE index as my barometer for macro concerns, right? I just want one number I can look at and go, okay, well, the macro environment is not calm right now. And I believe you were in the camp to say, I think that's fair. I know Darius had said it as well. But the point here is that the MOVE index is the bond VIX. And essentially what it looks at is the implied volatility of treasury options. And so that is the same thing if you were looking at the implied volatility of Apple or the S&P or anything else. Higher implied volatility means that traders are expecting more movement, right, in the underlying. So in this case, the underlying is just treasury options. And it's unusual for us to have this situation where the MOVE index is at or near all-time highs. And this is an all-time high that goes back to March of 2020. So we're not talking about like a local high. We're talking about significant, major event type highs. Yep. So that vol is extremely high. And then on this chart, I contrast that versus the VVIX, the VIX, and the skew index, that's the SDEX. And all three of those measurements are equity volatility measurements, right? And I can piece out exactly what those are.
Yeah, let's do it. Well, let's talk about all those three because you mentioned them. Let's just go through them one by one. So what is the VVIX?
Problem at all. So the VIX, we all understand. The VIX is as we just mentioned, it is the implied volatility average, right? It's an indexified measure of the implied volatility of S&P options that expire within the next 30 days. Fair enough. The VVIX is essentially a skew measurement for VIX options. So the VIX index has options that trade on it. And if you think that the market is about to crash, one of the ways you may buy protection is to buy calls in the VIX. Well, if the VVIX is low, that is signaling to us, that signals to the market that there's not a lot of demand for VIX out of the money calls in particular. So the VVIX is back now down to lows of 2019. That suggests that no one's really looking for a tail event right now. Similarly, the SDEX is the skew index. It's put out by nations. It's very similar to the skew index that's put out by the SIBO. It actually just has a cleaner calculation. There's a few less errors in it. And that skew index is the same thing as the VVIX, only it looks at S&P options. So if you were thinking or investors were worried about tail risk, right, they would bid up the price of puts and that skew index would move higher. But in this case, the VIX, the VVIX, the skew index, all of them are really kind of pushing near lows going back to 2020 or even before, while you had the bond VIX, which is at March of 2020 high. So there's a giant spread between those two.
That's
And
fast. Sorry, do you have any theories on why?
I would ask you, as the macro guy here, look, nobody knows what the Fed is going to do. I think people may have, everyone's got opinions, clearly, and it's inflation dependent. So if inflation comes down, then I think, then we'll pivot, right? We'll turn off of rates. And I think the market, the treasury market at least, doesn't really know how to adjust for that. And until there's more stability, I mean, I think just what was yesterday, they said we're going to raise 75, and the market, I think, was looking for 50, right? So there's just a lot of uncertainty. You're better off bringing this up, but my dummy take on it is that the treasury market cannot figure out what policy is yet, and until they do, that volatility is not coming down. I think even if the Fed's like, we're going to raise once 5%, and then we're never going to raise again, then the bond volatility would still probably come down, because we can all go, okay, I can price this stuff in now, right? I know what to expect. But right here, we don't know.
So I would agree with that. The one thing I would say, though, I've been arguing for a long time that the next crisis is going to come out of the bond market, not the stock market. Yeah. And I know that's very non-standard, because most people think, oh, no, not a chance. It'll be the stock market's going to collapse. And I push back and say, everyone always thinks that the next crisis is going to look like the last crisis. And I remember very well, Brent, in 2008 or 7 and 8, that everyone thought that we were going to have a crash in tech stocks. And the reason they thought that was because of the dot-com boom. And what did we have? We had a crash in credit. We had a crash in real estate. We had a crash in kind of private credit of all sorts there. And it was something nobody would expect. And that's the reason that it was a crash, was because nobody could hedge for it. And I wonder, and I'm not sure about this because I haven't given this much thought, but I wonder if the bond market is rightfully recognized that it's got a lot more risk in it than the stock market. And the stock market is not getting bid up because it's not as risky in terms of on a relative basis. Like, I realize in an absolute basis that it's much more risky, but on a relative basis, it's not as risky as the bonds.
I wholeheartedly agree with you there. I think that it's funny you say that not a lot of people agree with that, because I've always sort of been brought up to think that the bond market, that equities will be the last one to wake up to something. And I remember I too remember 2008 and thinking, what the heck is going on? But the equity market hung on. And even in February 2020, where it was clear that things are not okay, right? And we just kept making new highs, and you're going like, what?
Yeah. Well,
this is insanity. And then all of a sudden it was like, game over in the matter of like a week, right?
But the other thing, sorry to interrupt, but the other thing to think about is that if we think about this current decline that we've had, yes, it's been somewhat ugly in stocks, but compared to bonds on a relative basis, this has been, what is it, a 30, 40-year bond bear market? Yeah. It's been worse than any time over the last 30, 40 years. And I think it might have even been worse than the 1982 or whatever it was. And so my point is that bond vol is high because it rightfully should be, because we've experienced a crash and it continues to exhibit lots of risk. And I think it's just a function that we're all so used to talking about stocks. We're all so used to talking about the VIX and options. And yet, if you look at it, the bond market is a monstrous market, and it's had probably a once-in-a-lifetime crash. And very few people talk about that. Very few people will say, we'll talk about how ugly it has been. And yet, and everyone's still focused on the stocks. And I think that's what we're seeing.
Yeah, I defer to you on this stuff, and I agree with these sentiments. And I think just from the equity valuation perspective, I don't think that we can have a sustained rally in equities, because it doesn't matter what you're doing. The fundamental sort of element in everything is rates, right? Because if I can get a better rate of return off of owning treasuries, if I get 8% on treasuries, I'm going to do that than own equities, right? And so I just, I think that the problem is we came off of 71 all-time highs, right, last year. And now stuff is going to get repriced. It just has to be. Future cash flows are different, yada, yada, yada. All the fundamental drivers are different. And so like you say, the move index kind of makes sense. To me, it just makes sense that it's at a high. Again, I'm a layman here. We're looking at the bond market, but when I just say, okay, if that move index breaks down under, let's say 100, I'm going to be much more comfortable getting long equities because the bond market is like, okay, we're solid now. We kind of have a better picture of what's happening. And that bond volatility coming down tells me that, okay, there's probably now a real floor in equities, not like one of these tradable 10% rallies and then 15% pukes the next day.
So is that your major signal that you're looking for in terms of what might be the catalyst for a sustained stock market move?
That is. And our basic model, like our SpotGamma basic model, is that we have this negative gamma, positive gamma metric, right? And all that essentially tells us is what is the larger position in the options market? Is it calls or is it puts? And we very rarely get over into the kind of above this gamma flip level where it's call positions are dominating. And the few times we have seen call positions really come into the market, the market will give a very kind of brief fleeting rally, and then these calls expire and the market seems to really flip. And my point with this is that we are not seeing large, big call positions in a way that we've seen them over the last 3 or 4 years. And those call positions bring a suppression of volatility and they're a stabilizing force in the market. We're not getting those. And I think in the similar way that we were looking at realized vol, and I was talking about liquidity in the E-minis and things like that, where in late last year, something broke, right? And I think it was the Fed saying, we're going to start raising rates, get ready. And everyone started position for that. I think when the Fed is finally like, look, we think we're done here now, right? Things feel good, or we get 2 inflation readings in a row that people like, or whatever it is, we're going to see those call positions come into the market. And that's going to be along with that move index coming down. I think those two are going to happen at the same time. I do think the big macro funds are probably not watching this, right? But this is probably a 30,000 foot idea of what they're considering.
No, I think that's a great idea, Brent. Like I've never, again, I think that's outside the box thinking that a lot of people are really putting out there. So let me just be clear though, when you say the calls coming in, are those clients buying calls or are those clients selling calls? Because in general, aren't institutional clients sellers of like SPX calls? I guess I just want to understand what you're trying to say with the calls a little bit better.
Yeah. I think it's both. So look, this is not a good environment for selling calls. It's a terrible environment for selling calls because this is longer dated calls, because the potential for a market rally is so big here, and volatility is so high that yes, if you sell some calls and vol comes down, that's fine. But the market, as we just witnessed, can rip 2-3% in a matter of a day, right? And so I think if you think that this is a structural low in equities, you do not want to cap your equity upside. And that's what a lot of that call selling is. And I think historically you get, a very positive market. We keep making new highs. I want to add some yield to that. That feels good. And we're going to keep, selling. And also, there's also just been a deleveraging, I think, in the equity market as well, which I think also coincides with less call volume in that call overriding respect, right? But even if you just say, look, Brent, this is, I don't believe that people sell calls like that anyways. Well, then I want to see long calls come in. That's in a way that's sort of a similar signal, right? People are interested in getting long the market. So either way you sort of look at it, this market is really controlled by put trading. When people are buying puts, it forces the market down. When people are selling puts, it brings the market back up. And that is what characterizes, a lot of the volatility we see in the positioning we see. And so I think that, again, once that move index breaks down and bond vol comes in, you will see that call interest pick up. And I think it'll be sort of a while before it's really call selling that is that real stabilizing force come back.
Can I ask you?
I just want to offer this.
Oh, sorry. Go ahead.
Sorry, please go ahead.
No,
No, I don't want to cut you off.
Okay, well, I was going to ask because I think it dovetails into this really well. Jason Gofford, I don't know how to say his name.
Yeah,
I should know.
Sentiment trader.
Because he was actually on our show. Jason, I apologize for butchering your last name. He had this great chart that a lot of people are talking about, which shows the institutional net calls or puts, the net basically options bought or calls versus puts over the last little while, and it had gone from a huge positive in 2021 to record low, meaning that they were buying all sorts of puts. And now the one thing is he very quickly said, someone rightfully pointed out that you need to normalize that for the size of the market. And he made another chart that showed that, yes, it's not quite as dramatic as he made it look when you normalized it for the market, but it's still record amounts of puts being bought. Why don't you tell me what you think's happening there? And how does this relate to your theory about how the market's setting up?
Yeah, one I would say kudos to Jason, because I put out the same chart. My graphic wasn't as pretty. I put that same chart out 2 days before. Mine fell like a tree fell in the woods and no one heard it. So what the chart shows is that equity put buying, particularly by institutions. So the way that they measure this is this data comes from the OCC, which is the Options Clearing Corp, and they actually tell us on a weekly basis how much calls were bought or sold, and how much puts were bought and sold, and they tell us on a notional value. And then they break it down by contract size. So they'll tell you in small lots, which is 1 to 10, or then they'll say, okay, or over 50 lots. So you can say, okay, small lots is probably retail, and then big lots, 50 lots that traded or more in a single trade, that's institutional flow. So all of the trades that were done for last week that were 50 or larger, what was the put premium bought? And when you look at that chart, it is at 2-year highs. Whether you normalize it or don't, it clearly shows that big institutions were out buying puts. They were not buying calls. This was not a retail phenomenon. Call buying is falling off a cliff across retail and institutions, but there was this big surge in put buying. Now, a few people have mentioned that there was a big deal. I think it was in 3M, some reverse conversions traded. So there could be some sort of merger arbitrage or deal flow around that exacerbated this a little bit as well. But the point here is that equity put buying still is very high. That is kind of the dominant flow, along with a tick up in SPX and in index and ETF put buying. That's the clear trend. And that was big institutions doing that. I think that if you wanted to short this market, the more interesting way is to look at puts in the single stock space, because you get much more convexity there. And what do I mean by that? Well, if you buy puts in AMC or ARC or NVIDIA, right? Those stocks are more likely to drop 5 to 10%, right? And give you a big convex payoff in your put position than the S&P. As we sort of alluded to this earlier, the S&P has just been in this grind down lower all year, right? So if you've owned sort of crash protection in the S&P, out of the money puts, they really not paid off much this year. And I think that feeds back into, again, this move versus VVIX conversation, where tail risk has not done anything for you here. If anything, it's just been a drag in your portfolio and probably hasn't protected you from anything.
Right.
So do you want to then go into sourcing downside protection in single stocks? And I think that has become a much more attractive place to look for hedges. Particularly, we can also get into sort of what's the fundamental backdrop for a meme stock versus, I can get more pure, sort of a more pure fundamental view shorting a certain basket of names versus like, I don't want to short, Costco or McDonald's here because fundamentally they have a stronger, tailwind.
Okay, so let's look at this last slide. It's called Catalyst Soup. What do you got there?
So let me just one quick thing. So the VVIX, the skew index, all those things, and this idea of tail risk, a lot of people I think are selling that tail risk now, and that's absorbing some of the downdrafts we're having. That is a risk to the market, in my view. You have the move index, which is saying the bond market isn't sitting right. And then you have equity traders who look like they are selling tail risk, right? And so if something happens where suddenly we go, oh man, things are broken, maybe that comes out of the European Union. I think that's maybe where I think a tail risk could come from. Then suddenly you have not only people need to start buying puts, which they're not doing, but then there could also be this short cover, right, on people who aren't really long any tail risk here that suddenly need it, right? So maybe they're short it and they got to go from like flat to long, and that really becomes an extra driver, or sort of it raises the vol, I guess, potential quite a bit.
Okay, I get it. The fact that there isn't a skew shows that either people are shorting it or aren't as protected about it. Nobody's buying it is in essence.
Yeah, there seems to be no respect. And I think it's sort of like the boy who cried wolf. Like, we've seen this move index chart for a year now. Nothing's happened. Old news, right?
Okay. All right. What's the Catalyst Soup?
Okay, Catalyst Soup is just some of the data points we talked over the next week. So why would you want to maybe not be short volatility right here? We've already talked about this. It's September. It's the CPI release that comes out on the 13th. Then you have September OPEX on the Friday, which again is not necessarily a catalyst to be long or short vol, but it is a driver of volatility. If the market goes up because of the options position, again, we're up already 3 or 4%. So that same kicker is not quite there, but still that's going to be a tailwind for equities if we rally. But at the same time, if we turn and start to sell off a little bit and vol starts to go up, those are all the same forces that could violently drive this thing back down into Friday's OPEX. So there's no equity stability really up until I would say the 21st. And the 21st is VIX expiration as well as the Fed. So those are two big catalysts from the options landscape. We could come out here with a happy CPI number, a Fed that says, all right, we're backing off now. Everybody loves it. And we could easily rip back to 4,300 in the matter of a week or two, right? No problem. And who knows, if the CPI reading isn't so good and the Fed is like, look, you guys don't believe me, we're sticking with our path of 75 or 100 bips increases, we could easily drive sharply lower in the market, right? And so anyone who may guess at this I think it's kind of just a guess, but the point here is that this options positioning, right? Elevated volatility that's come down, big options position, that's all just a huge driver of volatility. And so you want to be prepared for playing those larger trading ranges.
So no let up in volatility until the 21st. No sleep till Brooklyn.
Yeah, because right. And so what I would expect would happen is we're going to get a pause on Monday, Tuesday, right? Kind of in before the FOMC. We could get some real drift in here. And that's, 10, 11 days away. But volatility in the VIX is not going to go all the way back down, until we get through the FOMC because of that event vol. And so, if you're a trader and you're pretty tactical and you're quick, there's some great swings to come in here. But I'm of the opinion, if you have your 401k sitting in cash and you're waiting for that all clear, then I would look at coming out of the 21st as just a more clear all signal. So maybe you only catch 5% of a rally, but it's going to be a arguably more stable rally because the catalysts are behind us.
Sounds great. Now, Brent, why don't you tell people a little bit about SpotGamma, what you do, where they can find it, the whole 9 yards.
Yeah, thanks for the opportunity. So I write a daily note that covers a lot of things we've been talking about here that comes out every morning. You can get that at SpotGamma.com. We have a bunch of different tools and analytics that you can look at as well. Incidentally, what we did here is we set up a code. So if you use, when you check out, if you use Market Huddle, you get 50% off, which is 2 free weeks on a trial. So I think it's a great time to just consider our analysis here as we head into these big options catalysts.
Oh, well, that's terrific. Thank you for doing that. I didn't realize that. So it's Market Huddle is the code.
All one word.
Yeah, and it's SpotGamma, SpotGamma. And the other thing I'd just like to give you a quick shout out for is that, Brent, you do a great YouTube channel. And if anybody's on the fence and wants to see more of your stuff, you have all sorts of content on there that's terrific. Why don't you tell people, I guess they just go to YouTube and search for SpotGamma?
Yeah, you can do that. You can go to youtube.com/SpotGamma. I try to put up a lot of videos there that are explanatory and not so much like just overt sales or marketing.
Yeah, no, it's terrific.
I think there's a lot to learn there.
I think if anybody is kind of on the fence and is interested as well, like obviously go out, get yourself a month and check it out. I think it's well worth it. All right, so folks, go check out Brent's YouTube channel and at YouTube/SpotGamma, or if you want, and you should go check out the Market Huddle promo code and go check out getting months of his great product. And before we go, Brent, I'm always interested in what you're doing, what you're up to in your personal life, and you've always got a good story. And now you're telling me that you are going to see Tony Robbins.
Yeah, I did it once. My wife kind of had me do it a couple of years ago, and man, it was just awesome. I loved it. It gets you, I feel like in this day and age, you need some positivity and some excitement and just some good vibes, so to speak. And so he runs this seminar that hasn't been on because of COVID. And so I'm going down there with some buddies in November, and I'm gonna get my my good vibes going.
Your good vibes. Now, is he as tall as he? Like he's like 6'6"?
He's humongous.
Yeah, he is, right?
And he's got the biggest hands I've ever seen, and he loves clapping. It's this funny thing because it looks like someone's waving around like foamy hands, But it's just it's like an uplifting, energetic, experience, and I think that it's important for people. And And so I'm sure that'll draw a few giggles around, but don't knock it till you try. It's my advice.
That's right. That's right. You can't knock it till you've been there.
Yeah.
All right.
Especially, these trying times, man. It's tough. I know you Canadians are maybe a little more affected by Queen Elizabeth than us here in the States, but there's just a lot of tough things going on.
I agree with you, Brenton. There's going out and finding something to smile about and to see the positive in the world. I feel like there's too many people that are, busy seeing all the bad things when there's all sorts of good things. And I'll tell you, it doesn't surprise me at all that you're going to see Tony Robbins, because you are one of the good guys. You're always seeing the good things in life, and listen. I watch your show, and your podcast. I enjoy it all the time. I think you're a terrific contributor to the FinTwit community and to the financial landscape, and I think it's a great product, and it's always a pleasure having you on the show. And I just want to thank you for your time.
Thank you, Kevin. I can't appreciate it. I can't say how much I appreciate it enough. And you guys always give me a great platform and opportunity. So I'm in a lot of gratitude for that.
Thanks again. Take care. All right, Patrick, it's time for Talking Charts. It's been a while since we've done this.
Well, yeah, we had a summer break, and boy, the market has been moving quite a bit. It's customary that during when we take some time off, that shit just hits the fan, right?
Yeah. It's also, I have to give kudos to you. You've called it pretty well in terms of.
Okay, stop it. All right, let's just go on. Thanks for the shout out, but let's do it. Anyway, a few weeks ago, there's no point in going into too much detail because this is now so stale, but we were doing the top 3 things to watch like 3 weeks ago. We were looking at the GDP, the US dollar, and the Jackson Hole Symposium. And while the dollar did continue higher, and I guess Powell had...
I would say although the first 2 were definitely market-moving events that ended up being very important.
Yeah, it did. I didn't think Jackson Hole was going to be that important, and I was wrong. I thought they were going to stay down the center, and really, there was new information revealed there.
I will push back. I agree that the market interpreted there was new information there, but he didn't actually commit to anything.
Yeah,
he committed to not being Arthur Burns, but that's it. But that was enough to get the market spooked. So it doesn't matter whether what we interpret him as having said, it's what the market interprets him as having said. And there's no doubt about it. It ended up being a big deal.
So let's talk about the top 3 things this week to watch. And first, number 3 was, does the market fade the sentiment? And I don't know what the sentiment is in the general public, but when you go to the Twitter sphere and generally most strategists, there is been a very thick and heavy layer of bearishness, and at least a lack of optimism. Maybe if not outright, like you could say outright bearishness, but certainly it was very hard to find a bull, as opposed to saying that everyone's bearish. Everyone had that negative. And whenever everyone's so convinced the market's going down, rarely does the market reward everyone with giving them what everyone expects. And so my number 3 is, does the market fade the sentiment? Like, do we just, go into the midterm elections with a market that, heads right back upwards to the top end of the summer range and just kind of muddles along, and all of this negative sentiment suddenly just kind of unwinds a bit? What's your thinking?
Well, could we climb that wall of worry? I would say the wall's pretty tall, and that's what I will agree with you there. I contend that this is, as in terms of sentiment, it's as bad as any time that I've remembered. And I saw a great chart from Bespoke Investments that measures the AAII bearish sentiment reading, and I think it was George Perks. It was if you average out the sentiment for every week, this is the most bearish average year since the sentiment started, since the survey started getting recorded in 1987.
Oh, come on. You're saying that the sentiment's more bearish than it was in 2008.
I'm saying that the AAII average investor survey sentiment, the survey over the last, if you take the average of each reading up until now, it is the higher in terms of bearishness than any year prior.
So I want to push back on this. Okay, so yeah, listen, I hear you. I agree that I wouldn't have made this number 3 if I didn't feel the negative sentiment was there that me and you both agree exists, right? But the thing is that it's still a bear market. And just because sentiment is negative can't necessarily, in my opinion, start a new bull market. It's simply that the market is not likely to reward those people by going down when everyone has already planned for it. So that doesn't make me necessarily inversely bullish because of the negative sentiment. I just think that it's going to be hard for bears to be rewarded on the downside in this period, right?
I don't disagree. Patrick, I've been saying for a long time that I think the market chops around and does nothing and frustrates the bulls and bears alike. Having said that, given this sentiment, I just think that the conditions, if we do get a switch for whatever reason, let's just imagine it ends up being a good CPI or the Powell does pivot, the conditions for a right tail spike are higher than most would guess anyway.
So
that's what makes a market.
Here's a chart of the S&P 500, and one of the things I'm watching here, Kev, is the 4100 more or less is about I'm obviously rounding, but it's roughly the halfway point of the sell-off of where we went from about 4,300 down to 3,900, and so we're at a situation where typically we were oversold for about 6-7 days. A bounce usually retraces about half of what it was previously sold. So I think that the most important thing to watch into next week is whether the Friday rally we just had here gets faded. If we start seeing legitimate price action bullishly follow through north of 4,100, that's some serious points for the bulls. And so I think which way Monday starts is going to be pivotal in terms of whether I think that there's some more further short-term upside on the markets here.
All right, what do you got for number 2?
U.S. dollar yen. Well, I wanted to put U.S. dollar, but we did that last time, so I had to give it a little bit of a twist. But listen, I was bullish the dollar, and I thought it could go higher. But even the temptation to fade this is too much. I joined the dark side and faded it.
Well, you know what, Patrick? At this point, I'll welcome your company because you nailed it all the way up in terms of the U.S. dollar. And if you're fading this, welcome to the dark side.
Yeah,
grab a lightsaber.
You know what though? I'll tell you though. Listen, I'm actually on a short leash, and the thing is that I might come on in a week and say no, I'm flat. Like
I understand. You're taking a stab because I'm
taking a stab.
Overdone.
This is not a macro positioning.
Only idiots like me do that.
Well, no, but you know what? There's going to be a time, but I'm going to wait till the trend's my friend, something you don't like doing. But
yeah, I don't like that trend guy.
Yeah.
He's not friendly. He doesn't like me. We don't get along at all.
Anyway, but the point is, the U.S. dollar in general has had a great run. And the thing is that we're such an interesting technical moment on all currencies. I picked on the U.S. dollar yen because it just had such a redonkulous rip. We often talk about the acceleration of slope. And just seems like this is almost like a blow-off acceleration. I mean, we went from basically 130 up to 145 in a month. It's just extraordinary rate of change that just accelerated this. And at the same time as that, what's interesting is the pound sterling had another full leg lower. When we do measured moves, it basically completed a move to the downside. And you had a big rip in the U.S. dollar renminbi. You had the Canadian dollar double bottom retest. You had the Australian dollar double bottom retest. And what was interesting the most, though, Kev, is that I would have thought, based upon the circumstances, that the Euro USD would have had a leg down that would have at least mirrored or echoed the pound sterling. And know what happened? It temporarily turtle head poked down to a lower low and reversed immediately. The downside momentum of the euro is gone. And you know what? That just kind of makes me ask the question. Look, you know what? I'm not ready to make a macro call on the dollar, but this trend of the dollar up has been like this all year. And inevitably, at some point in a 9-inning game, the game takes a pause. They're like, are we in that 8th or 9th inning? Is probably the better way of saying. Like, I just think that without making a big macro call that there's a massive U.S. dollar bear coming, I just think it's just gone a little too far, and there's so much room for this trend to be faded. But there's a bigger macro thing to that, Kevin, in my mind, because if for whatever reason that came to fruition and the dollar did fade the other way, that could be the risk-on impulse to drive everything higher on the interim.
I completely agree. And I will make the macro call. I think the dollar's headed way lower, but I'm wrong so far. It just keeps sucking all the oxygen out of the room, and it's reached levels, as you mentioned, that's going to be tough for it to continue.
Yeah.
And it comes down to, Patrick, everyone believing that the Fed is going to crush the economy no matter what. And I don't believe it, and we'll see. It'll be interesting to see. Is Powell really as hawkish as he makes out to be? He certainly convinced the market of that. Let's put it that way. Yeah. All right. What's number one? What are we watching next week?
I'm going to pass the baton over to you. What the hell's going to happen with those inflation numbers?
Oh, God,
next week,
I'm not going to guess. I'm not going to guess. I actually, it's any 1 month is almost random noise. I will say, though, they're not expecting very much. Like, if you look at the month over month, they're not expecting much, and probably rightfully so. As you mentioned,
there's one chart thank you. I was literally going to say it if you didn't. Like, look at the Eiffel Tower formation of gasoline.
Yeah.
Like, literally, it's almost hit the concrete pad on the other side.
Crazy old Joe managed to do what he said he was going to do.
Like,
he released half of the SPR, but otherwise everything's good.
But literally gasoline's been halved. And so if there was ever going to be a period where inflation was going to have the wind taken out of its sails and it mean revert, like we're not talking about obviously deflation. It's just simply the rate of change on the upside that brought those redonkulous numbers is just going to normalize, right? And like whether that's 4%, whether it's 3%, 2%, I'm not going to try to guess. But the thing is that commodities have been pulling back, and they are a huge input variable into these inflation trends, and so there's a real chance that inflation is cooling here.
I don't disagree. I do think that any 1 month is a lot of random noise, and I worry that the market will overread too much into 1 month. But let's just put it this way, Patrick. What if we got month over month deflation, which is not, listen, I probably just goochered it by talking about this, and it's probably going to be like way high. It's smoking hot number, but it's not that far off of where the market is pricing to expect that. Yeah. Then all of a sudden, all these folks that are, crowing about inflation will be, holy smokes, look at this.
And then you're going to get stopped out of all your bond shorts.
Probably would. Although it might help my steepener.
Well,
so
you got to be hedged somehow,
listen,
right?
my portfolio is complicated enough that I'll lose no matter what. All right.
All right. Well, listen, I just wanted to touch on a couple other things. We'll keep this one tight because we had a lot of great interviews. I wanted to just look at that chart on crude oil. Now, while crude oil did break to a lower low, I'm going to use I'm almost scared of killing the turtle head formation reference
by talking about it.
But
you're really into the turtle heads this week.
You know what? It's a time in the markets where turtle heads. It's like everyone ate too much tacos, and it's one of those. It's that period afterwards where you pay the price for it, right? The point though is that. With oil broke to a lower low. And what's interesting is, first of all, you look at energy stocks, and they don't give a shit. They didn't get the memo. In fact, energy stocks continue to set up quite bullishly. And I asked the question, when you kind of look at it from that context, like, what if this was the washout? That, everyone just, for 2 months in a row, all of July and August, $85 held. Oil tested it. Oil tested it. Here, everyone's got their stop losses sitting below. Everyone's like waiting for that trigger. It just washes everyone out with this quick drop, and then gets right back into that trade range. I don't want to say something outright bullish. It's too premature. But wouldn't it be interesting if oil got right back into the 90s and settled in there? That would basically, to me, start to really ask the question as to whether the downside of oil is behind us. But it hasn't yet done that? No. So what this definitely is something I'm watching next week, is whether or not oil can kind of immediately erase this breakdown move. And that's on my mind anyway.
Good stuff. What else you got for us?
Gold. What's interesting? Gold has, everyone talks about real rates and all these other types of things that drive gold. But, when you overlay gold with something, I'm just going to pick on the pound sterling. Just look at the correlation of the highs and lows. Gold has just been behaving like a cross currency. Actually, even forget the pound. Like, put, for instance, gold overlaid against the CAD USD, not USD CAD, right? Just to think. But like, it literally has been behaving like a currency.
Yeah, I know that when I do the old Dennis Garman gold price in yen, it gets really boring.
Yeah, and so my thought here is, what if your call on the dollar's right? Then this is the bottom of gold. Oh. Now, I'm not saying that bottom isn't, but you seem to feel convinced. But
no, I'm not. Listen, you're talking to a U.S. dollar bear that got almost timed it right, and then the bull market decided to put it in reverse and run me over one more time.
So anyway, all I'm saying, I think that the correlation of gold to the currencies remains, which is, if the dollar tops, the bottom will be in gold. And now that's an if, because we don't know that that's the case, but I think that correlation will stick. And so the thing is that nobody wants to talk about gold anymore. No one gives a shit about it. Everyone keeps talking about it's dead. That's when I love it the most. Like, you know what?
Did you say everyone who keeps talking about it is dead?
No, it thinks it's dead. Sorry.
Oh, I thought you said everyone that's talking about it is dead, because like they're so old.
Well, that actually is partially true, even though I
have one of my subscribers, a really good guy, and he is a young millennial, and whenever I talk about gold in any way, he sends me a boomer alert.
Well, you know what? Anyway,
send you one too, Patrick.
Patrick, I'm going to put on my.
Patrick's getting bullish gold. Everyone, send him some boomer alerts.
I didn't say that. Anyway, all right. Anyway, listen, that's enough. By the way, I just want to talk about one other thing: uranium. This really kicked in after we took a summer break, but obviously Japan firing up the nuclear reactors has gotten a little bit of buzz, eh?
That seemed to be the catalyst, and you're absolutely correct. It's just grinding higher.
It's just
like when you take too much and it just keeps kicking in and it just won't go away.
Yeah,
the high won't go away.
It's interesting because it actually is one of the kind of commodity markets that actually seems to be kind of marching to the beat of its own drum. It'll be really interesting to see whether or not it continues. All right, listen, that's enough for the talking charts. Let's move on, buddy.
All right, it is time for skin in the game, and I have to put my head down in shame. That was a terrible call on my part.
Well, you made the bet. You gave me a shot at this, right?
Yeah, so what was it? We bet on the S&P 500.
Yeah, it was an over under on the Friday close on
42.30. How close was I?
Not at all. Like it
I'm
literally
130 points
just
off.
kept
It went straight
going
down, like the
it went
moment
straight
after.
down, never looked back. Fine, all right. Like it's now at 4,000.
Listen, you deserve kudos. You actually timed that, and you were
You made the bet. I just took
no.
it.
But
Like,
listen. I'm just talking about I actually know your positions, and I know what you're talking about, and you actually did a terrific job at timing this correction. I stuck around in the bull party too long just because everyone was telling me it was going to go down, and God damn it, they were right. I should have listened to them. Funny how that works.
So,
all right.
I
So
want to have a little. Okay, go for it. Tell
one
the
second,
rules.
I got to tell her a little explaining. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and we're going to play the game now to 50 points. The loser of the match will take out 3 lucky or unlucky, depending on how you think about things, Market Huddle listeners for a dinner where they can grill him about why he had so many bad calls. Each week, Kevin and Patrick will be able to bet anywhere from 1 to 10 points on each bet, and once someone hits that 50, the game will be over, and the loser will need to start figuring out restaurant reservations. Patrick, what do we got for this week?
All right, bud. I'm going to go.
This is the score, by the way. So now it's 15-19. How much did we bet last time?
So that's including the
no,
my
but
win today?
is this up to date with?
Yeah.
Patrick was that far behind.
Yeah,
even with this win.
It's,
okay, 10-19. Patrick's got a lot of catching up to do. Okay.
So I'm gonna go into the world where you have an edge.
Oh.
I wanna bet on
it's a trap.
The 530s.
Admiral Akbar.
Yeah.
Oh, you're not. You're just doing this to mess with me.
Yeah. We're going to the 530 yield curve, and it's trading basically at zero, right? Like, I mean, this is we're right here, and I'm gonna let you take the over under.
Oh, over,
right?
Yeah, and I'm 10 bid. You just pick your price.
Maybe I should have fucking given you some. Oh, you bastard. I'm going to just do 3 points.
Okay. All right. So it's the 530s. It basically it unched, even, and it's up or down from. Is it close enough to even that we'll just call it even? Or
it's 0.014. I mean, that's.
Oh, no. I want those 1.4 basis points. I'm not going to let you chisel me on that one. Okay. So it's 1.4 basis points, Lena, on the 530 spread. I'm taking up. 3 points only, though.
Only, maybe I should have picked something else. I feel like.
Well, you should. Not only that, when someone when someone goes 10 bid, he's obviously way too cocky. You hit him. Too late now, though.
Too late. Damn it.
I'm gonna lose because it's like a position I like and have on, and I'm cocky, but I'm gonna lose for sure. All right.
Well, you know what? The inflation numbers are going to decide this for you.
Yeah, but not only that, the fact that you only bet 3 definitely means I'm going to lose. Okay, it's time for No Stupid Questions. Lena.
Hello.
Welcome back. Why don't you go ahead and read some questions?
So first question here. Hey guys, really appreciated all the great interviews. My question is, what do you think of the traders with not much capital of prop firms such as FTMO, Surge Trader, etc.? Do you think they're good options to get some funding? Cheers, guys.
This is more your area.
Okay. I can't speak to any of those firms. And I guess what I would recommend is that you spend a lot of time learning about the firm you're potentially going for. Because I think that this is one of those endeavors where there'll be some great ones that you'll learn a lot. It'll be a terrific environment. It'll be fair and you won't get ripped off. And then there'll be other ones that'll be a disaster. It's basically just a scam where they're trying to, make money off of you, whatever. So the kind of in principle, if you find the right one, I think it's a great environment, terrific place to be. It's a lot of fun. I went to one when I was in New York City, Patrick. I got there. It was like it was in Midtown. I went there. It went up. It's like an entire floor. the guy that I was meeting was 40 years old, and he was the oldest guy by 10 years. It was just literally just desks and desks of like
Kids.
25 to 30-year-olds in shorts with like their dogs beside them. And listen, if I was a young fellow, I would be all over it. So the kind of, in principle, I love it. Make sure you spend some time researching it, because I think that there are things to watch out for. I don't have any specific about those firms. I've never even heard of those ones.
All right. Lena, what's the next one?
Hey, I'm a huge fan and a serial question asker. My question is about buying options on a Friday. Am I theta effing myself by losing 2 days over the weekend, or is that priced in? Am I better off to just wait till Monday to get all theta I can get out my little bag of theta cracks? Thanks.
Well, I'll first start, and then you can add to it, Kev. But like, I do know, I've heard a number of stories from those people that traded 20, 30 years ago, where the dealers never adjusted for this, and there was an easy grab on selling premium over weekends. But eventually, that arbitrage, or that little window, got closed by them baking it into the cake. Do you have a more kind of?
Well, I think it's kind of funny, because you mentioned 20, 30 years ago trading. When I was at the bank and when we were trading index options, we would take it at Friday at, I don't know, somewhere 10:30, 11. We would move our book to Saturday, meaning we would take all of our sheets and would move them ahead by that amount. I don't know specifically how scientific they are now about it, but the real question is this already taken into account for the prices? 100%.
Yeah.
Citadel and all those folks are trading it, and they figured out the optimal way of taking it down at the proper time. It would be interesting to find out, like, if you looked at it, when that data comes out of it, meaning like, when do they push it forward?
Yeah.
Is it at 10 o'clock? Is it 11? Is it linear even? Might be even linear through all of Friday. Anyways, the long and short of it is, don't worry about it. The market's already figured it out. The market's way more efficient than almost any human can tell.
I would almost argue that by it being priced in on Fridays, you can almost, in theory, buy yourself the weekend lottery ticket of if something happens over the weekend.
Well, except that you got to think that they're also putting that in there.
It's all
no,
priced
honestly,
in. No, you have to make a market call. No, you're right. You're right. I'm not going
right.
to try to
They're combining the fact that there's less like chance of market movement, but then there's also more chance of geopolitical movement. So how much do you take out and when? That's why I was saying it would be interesting to see when they take out.
Yeah.
Anyways, good question.
Yeah. You know?
All right, last question here. Hey guys, love the show. Stupid question that I can't find the answer to online, outside of maybe a Seeking Alpha article that I don't trust and I can't find again. In the 4 possible curve scenarios, bear steepener, bear flatter, and both for bull, is there a consistent general performance for equity sectors for some period of time? For instance, if one thinks the bear steepener is coming up, could one with limited choices in their 401k rotate accordingly into sectors that perform better in that environment versus other sectors? Thanks. Keep up the good work.
This is a great question, and 100% you could do that, and there will be sectors that traditionally work in all those different environments. The only caveat that I will say is that we have never had this sort of bear market in bonds. We had Rob talking about how this is the worst 8 months of to start the year ever in bonds in the history of the bond market. So, although I think that's a good guidepost to look at, I would be careful about assuming that it might continue to work as well as it has in the past, because I think something is different in the bond market ever since the extreme fiscal stimulus that we've had. Do you have anything to add, Patrick?
Yeah, no, I agree. I just want to kind of add the hard part, and it sort of reinforces what you just said, is that we haven't seen, we're in a situation where the bond markets are really not truly acting the way you would have thought in the light of the huge volatility we've had in inflation numbers. Typically, bonds would have been far more responsive these type of inflation moves, and so the one thing that I find about that is like, you know, the market is no longer delivering textbook reactions. And while traditionally there are sectors that have responded in certain ways during these flatteners and steepeners, I just don't know how much you want to lean into them as that there's a high certainty they're going to work. I don't know. I feel like you almost need to have a second, confirmation tool beyond just using the yield curve to make the decision.
All right. Lena.
If you have any questions for Kevin and Patrick, please submit your questions to nostupidquestions@markethuddle.com.
No stupid questions, but only stupid answers.
That's right.
By telling what I just answered. Right?
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow on Twitter at the Market Huddle, especially Lena. She gets fed up with talking to Patrick and I all the time. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube. Please like and subscribe. Hit those buttons. You know the drill. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. Where can they find you, Kev?
I'm on Twitter at Kevin Muir, or you can check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. So now stick around for the after show.
All right.
Okay,
that was a good show.
Give us the review, Patrick.
You know what? So just to remind everyone, we've started this thing of rating each type of beer. So I'm going to rate this one in the world.
You did.
I must have missed
the
this
memo.
Market Huddle meeting when we decided this.
Well, because you always like rate it whether it's better or worse than Labatt 50. And therefore every beer is worse, and then you give it bad scores, right? And so anyway, I have started this thing. Me, yes,
Okay.
I've didn't let you in on the memo, but against IPAs, this is actually a great IPA. I was actually very skeptical. I only bought it because it had flying pigs on it. I thought that was just like a nice gimmick, and I'm drinking this beer, and I'm like, this is a fantastic beer. I'm actually going to give it an 8.4.
Whoa.
That's high score.
For
High
what
score.
for IPA, it's good. If anyone wants to grab a flying pig when you're out in Spain, I recommend it.
That's nice. All right. Well, we should keep it tight. But Lena, do you have any new stories or any new shows to tell us about?
Oh, I watched Rings of Power. and
House
of Dragons.
Okay, so we'll start with Rings of Power. Elon doesn't like it. Neil Gaiman stuck up for it, and now they're the nerds. The Tesla nerds are so confused. They don't know who to like. They're like, oh my god, Elon, Neil Gaiman. Who do I go for? Like, they're really confused.
All right, well, Lena, what did you like it?
I really enjoyed Lord of the Rings series and the Hobbit series. I went to go see them in theaters and all that. I was nerding out pretty hard, so I was really excited for the series. I'm not going to watch it again.
Really?
Yeah.
It was that bad.
It's not that it was
not
so
bad.
bad.
You're
Like, I don't want to say
tapping
it's
out.
bad. It's just, there's characters that you see in those movies and then you see it in series. First of all, I don't know who the casting director was. None of them look alike at all. They don't even resemble each other. So
Oh,
that
you mean
kind
like
of
the
bothered
elves
me.
that are like 800 years old or whatever?
Yeah,
right?
but like they don't like the
Yeah.
Hugo Weaving's characters in the series, but doesn't look anything like him at all. So I'm just like, that again, you lost me there. Plus, it's a lot of dialogue. I mean, yes, Lord of the Rings is a lot of dialogue too, but there's a lot of action, in between. And this was just, I dare I say, it was just boring.
So here, you want to know something interesting? The Rotten Tomatoes works again. And this is, we're always on the lookout for divergences between like when the critics like something.
Yeah.
There is a huge divergence. The critics, 84 to average tomato, That's the critics. The audience score, guess what it is?
I don't know, like in the 30s?
Yes, 39.
Oh.
That is terrible.
Yeah.
You know what? I just watched the preview and I immediately decided I wasn't going to watch it.
That is so bad.
I wanted to
must be
like
bad.
it. I wanted to like it. I watched the first episode and I said, okay, this is a bit of a slow burn. So I'll watch the second one. Maybe more will develop. But
Do you know they spend like $1 billion on that? Do you know what this is? Amazon just like shit the bed.
But I don't know
I know
where they
that's a
spent the
rude
money because the
expression.
the series doesn't look like it's super high budget either.
I don't know. Maybe someone's stuffing in their
You know
pockets.
what? I feel that the entire movie industry has been politicized, and they are running almost. They just stop making movies fun. Everything has to have an agenda almost in the background, and I think it's losing. I don't want to get political, but I'm just saying that movies just don't seem to have the same energy that they used to.
Yeah, we need more like Wayne and Garth. Party
Yeah,
on Garth.
Absolutely.
See, they didn't worry about politics. Shall we?
Exactly. Like.
All right, let's.
All right.
Sorry, let's talk about House of Dragon though. Let's ask her about this. And now let me just say this:
Yeah.
House of Dragon,
Yeah.
average tomato meter, 85, which is 1 tomato more. That's the critics. What do you think the average audience score is for House of Dragon?
Oh, I don't know because I actually enjoyed House of Dragons, so I don't know.
Yeah, so I'll tell you something. Do you know that if you go back to Game of Thrones, what's the fellow that writes Game of Thrones?
Oh my god, I always get the
Martin. Now we're forgetting.
George R. Martin or something, right? I
Yeah.
don't-
Okay. So he was
them
involved. He
confused.
wrote the books, and then he was somewhat involved. And then, like on the 5th or 6th season, the producers took off without him, and that's why that's why that last year was so bad. Was basically because
I kind of like that one last season. But
You
anyway,
did? You're like the only one, Patrick. Everyone
Yeah.
else hated it. Anyways, he's back. These are all based on books, and he's involved. And
Oh, maybe that's why it's so good. Because it was
so, yeah,
good.
everyone I know likes it. 84 tomatoes.
Wow.
So audience and critics agree, and I've watched it as well. I like it as well. I think
It's good.
it's well done. I think it's good. It's good for it to be back.
It's definitely making me keep
Nice.
my Crave subscription for one more year.
Oh yeah. 'Cause, yeah. For those who don't know, Crave is the Canadian. That's how you get your HBO.
Yeah.
Yeah.
Nice.
Anyways, Patrick, you watched either one?
Absolutely not.
Absolutely not. Well,
I-
Skip brings the power.
Yeah, well, you know what though? I actually do think I did watch the entire Game of Thrones series. So I think
you
I
were a
will-
fan. Like that
yeah,
was one
I
that you.
that's literally the only series in the last decade that I've ever been able to watch from start to finish.
Yeah.
I didn't even finish Breaking Bad. I did get through like 6 seasons of it. Or
Shame.
something.
That is
But-
shame. That
but
is
no,
shame.
but no,
Shame,
listen.
shame, shame.
No, I'm sorry, but listen, I made it farther in that than any other one beyond that. So I'm not trying to discredit. It's just my attention.
You have a
span.
high bar.
No, my
It's just,
atten-
you know
no,
what?
It's, no, it's attention
Lena,
span.
what do you
It's-
think? I'm pretty sure it was the nudity kept him going. Breaking Bad just didn't have enough nudity.
It's
That's
too
the
much,
problem.
too many guys on that show.
Yeah, too many guys.
Too many nude guys.
Okay, well, listen, Lena's got a lot of things, so we'll call it a night. Thanks
All
for
right.
tuning in, everyone. We'll see you next week.